Good morning and welcome. I'm Kyle Murphy, State Director for CEDA in Queensland. CEDA, the Committee for Economic Development of Australia, is a national independent organisation undertaking rigorous research, convening leading thinkers and committed to progressing good public policy for Australia's economic development. CEDA believes in free seating for morning sessions, and so don't stand there looking confused or frightened. Grab a seat. CEDA acknowledges that we meet today on Aboriginal land and pays respect to elders past and present. I'm pleased to have you all here for the first in CEDA's program of events for 2016. The annual Getting Back on the Horse event, the annual Economic and Political Overview. Each year, for more than 30 years, CEDA has presented its economic and political overview, drawing together leading thinkers and commentators to put forward their views, share their expertise and analysis on what the forward year holds. The 2016 publication, which you all now have, is released today, and today's events and proceedings are live streamed. In addition to live streaming, we'll be tweeting at #EPO2016. Today's release is followed by 8 more EPO events around the country, including next week in Townsville, progressing the discussion from the issues raised by our report authors, adding to it with expertise and speakers in each city over the coming months. So this epic annual endeavour is possible because CEDA's work is supported by its members, organisations across sectors and across professions and across the country who, like you, are committed to good public policy and to Australia's economic development. Today I want particularly to thank CEDA members, our National Economic and Political Overview sponsors, the University of Queensland, Australian Institute of Business and Economics, who have offered their expertise and joined with us on the whole national 2016 EPO adventure. Our thanks also to event supporting sponsor with whom we have worked for many years, Colin, Biggers and Paisley. Thank you both all and welcome. Thanks also in advance to our speakers this morning. AI Group Chief Economist Julie Toth, Credit Suisse's Chairman of Australian Investment Banking, John O'Sullivan, Warren Tees, who is Principal Advisor, Macroeconomic Conditions Division at Federal Treasury, and Gary Edstein, Chief Executive Officer and Senior Vice President, DHL Express Oceania. Our speakers, and you'll see a detailed biography in the event program, between them you will see many, many years of senior experience across government, private sector, local and international markets, across sectors and across professions. We thank them for applying their expertise to make comment and join discussion today on these critical economic and political issues for Australia for the year ahead. Welcome also today to CEDA directors, trustees, State Advisory Council members, governors and EPO report contributors Michael Blythe and Sam Churchill. Actually, you know what? Thank you all. By attending the full EPO forum here live, you're clearly committed to making an informed start to the year and to being part of a robust discussion to progress Australia's economic development. Also here, look, he wouldn't miss it for quids, CEDA Chief Executive, Professor the Honourable Stephen Martin. Stephen is, of course, the steward of CEDA's rigorous research program, and today is releasing his 5th Economic and Political Overview. In a moment, he'll talk you through the main points, an overview of the overview. We'll then hear from our 4 speakers and move from that straight into panel discussion and your questions, with Stephen as our benevolent moderator. Do help yourself to the brunch on your table. Tea and coffee will be served as we go. At the end of this session, we'll have a short break before we reconvene in the adjacent room across the hall for the EPO keynote lunch. So, that's the game plan. You've got the program. There's not much time to muck around today. To get us started, please welcome CEDA Chief Executive, Professor the Honourable Stephen Martin.
Well, thank you, Kyle, and to Kyle and all of her and our hard-working staff up here in Queensland, thank you for putting on such a terrific event. This is the first of the 9 that we'll be delivering around Australia. It's always a first in Queensland, I suppose, and as a consequence, I'm always delighted to be here to be part of that. It's actually my 6th, Kyle, but that's all right, who's counting, of the release of these EPOs. It just seems like 5. But this, I have to say, is an interesting time. I remarked up here when I came to the trustee welcome back that if I paraphrase our Prime Minister, there's not a more exciting time to be a member of CEDA. Well, that's right, but whether the excitement in Australia in terms of politics and the economic future of our country is going to be as exciting as perhaps he would want us to believe, that's a matter for discussion. I think a lot of that's going to come out, and you'll hear that in our presentations today. This report is sensational, I have to say. If you haven't read it online overnight, I'm sure you will. If you've got a hard copy here, you'll take it away. It's a page turner. It will not put you to sleep. It says some very wonderful things, even some of the Nostradamus-like predictions about what's going to happen in the economy and what's going to happen politically. They may actually come to fruition and dovetail. We have a pretty good record of this. But look, in a very serious way, if we take the economic chapter, I mean, what Michael Blythe from the Commonwealth Bank is saying effectively is that there's no chance of a recession in Australia, although there were some doomsayers last year suggested there would be. Secondly, I think there are some headwinds that the Australian economy is confronting, but effectively they are often beyond our control and they're international. What's happening in China at the moment? I mean, people are trying to second guess as to what the real figure of GDP growth is in that economy. People are trying to second guess what the direction that the government will set in trying to reset it from an exporting economy to one that really is domestically focused, consumer focused. And some of the reporting coming out over the last week or so would throw some of that into question. And of course, from Australia's perspective, 25 years of uninterrupted economic growth, big tick, fabulous. Doesn't matter who the government is, we were able to sustain that all the way through. But the issue has been, over the last 10, 15, 20 years, that most of that's been underpinned by a resources boom. A resources boom where we had an economy, China, that could buy as much as we could rip out of the ground. We had commodity prices that were astronomical. And you only have to think back 12 months ago, 18 months ago, iron ore was selling at about $120, $150 a tonne. It's down less than 40 now. And so these sorts of things have an impact on us. The price of oil at the moment, I mean, there's pumping oil out like there's no tomorrow, but the cost, the barrel cost of oil has come right down. So there's a whole raft of external factors and some shock factors that Michael Blythe is going to talk about, I'm sure, over lunch as well, that form part of our economic chapter that will impact on Australia. Who knows what's going to happen in the United States, for example? I mean, if you have a look at the major contenders for the presidency, well, I've got to say, geez, I'm glad I live in Australia. But quite frankly, what happens in the United States around growth? What happens in the United States affects the rest of the world, as does China. So there's external factors are going to be quite significant. When we look at what's happening in our own economy at the moment, one of the things that we've very much been talking about in recent times is just where business confidence happens to be. And the sad thing is, I think the business confidence is trending down, notwithstanding the change to a Prime Minister that I think most of the business community thought was going to be energised and deliver some really great things and talked up innovation and talked up things that mattered. But I think a lot of that confidence is starting to wane. If you happen to be a member of the Australian community, for example, that made any form of submission around taxation changes, you'd be mightily disappointed now. Doesn't matter if you're ACOS, doesn't matter if you're the Business Council of Australia. The fact that the government consistently now rules out one thing after another. We did have a very large table that the Prime Minister said everything was on. But what we see now is that the table's still there, but what's on it, you need a microscope to see what's going to be left. So I think the time for action, and I'd like to think, as we've said in our report, is going to come, and the first semblance of that will be at the budget. Now, we had the Treasury yesterday give a National Press Club address that set some of the parameters of that. We've got a representative of Federal Treasury with us today, and we'll hear something more probably about the direction of that. But of course, there are limiting factors, and consumer confidence apparently is bubbling along a little bit, but the housing industry in this country, there's got to be some questions about how much that will sustain us over the next 12 months. Why do I say that? Well, for a start, APRA has imposed a 10% cap on investment lending by banks in this country for investment properties in this country. Now, that's having an immediate effect now. I can tell you it's having an effect on people willing to invest. The idea was to try and stop some foreign investment coming in, but I think it's got an impact as well. Secondly, what's on the table is discussion around issues like negative gearing. We've got one side of politics suggesting a certain way to go. It was rubbish by the government, and then suddenly they came out and started talking about a different way that they were going to tackle negative gearing. So clearly it's one of the things that's still on the table. But a comprehensive taxation reform regime is not there. And I think this is one of the factors that is going to impact. The other thing that CEDA is doing some work on, and we're going to release something pretty significant about this next month, is that what has been forgotten in the economic debate in this country at the moment is the nature of the Australian government deficit. And the projections in my EFO as to where that's going to go unless there's some serious economic action taken. We've got a Treasurer yesterday who said that we only simply had an expenditure problem. 2 days before that, the Secretary of Treasury said we had a revenue and an expenditure problem, and that is right. You've got to admit that that's the case. So on one hand, you've got a government that's going to be faced with making some hard calls around expenditure, but it's also got to be around the fact that revenue is falling because wage rises over the last 3 years have been far less than they've been in the past. And the macro economy of Australia, where growth is forecast to go at 2.75%, not shabby at all. That's not bad considering the rest of the world. But 2.75%, cash rates set by the Reserve Bank at 2%, and inflation just above 2%, this is an environment that we haven't lived through before. And so the decisions that government is going to have to make, whether it be at budget time or over the next few years, is going to impact very solidly on what will happen to the budget deficit. CEDA's view is that that needs to be closed sooner rather than later, and as I say, we'll make some comment about that. If I conclude, though, a couple of comments very quickly on the politics side of things. Why wouldn't I? But a long time since I've been in it, so I've become much more agnostic, sort of. The fact is that, our political chapter says that the Turnbull government will be re-elected. And, if you have $5 and you're $85 down to Ladbrokes or something, put it on Turnbull, you'd probably be right. But, and there's always a but in this, I think expectations around the change in Prime Minister are starting to be questioned because of the activity and the action that government is doing. And a lot of reviews have been put on the back burner, whether it be taxation reform, green and white papers, whether it be Commonwealth-state relations with the new federation. I mean, all these things were there and something had to be done. And it's great to be talking about innovation, absolutely. And CEDA's written papers about this, and I'm personally committed to it and so on. But we need to see action match the rhetoric that's there. Now, politics being politics, you've got two sides of the game here now. One, of course, that's only been in opposition for a relatively short period of time, a leader that's not necessarily all that popular in the community compared to a Prime Minister whose, ratings are pretty stratospheric. That's political capital. And that's political capital that should be expended. And our view would be it can be expended if some hard decisions are made, because some hard decisions need to be made as Australia adjusts economically. Coming off a resources boom, looking at other things in the Australian economy that are going to sustain us. And our report goes into some of those. It does talk about things like advanced manufacturing. Again, CEDA reported on that a couple of years ago. It does talk about where the value of the dollar is and what that could mean for us. Certainly attractive from the tourist industry is concerned, and here in Queensland, wouldn't that be a great boon? We should see more of that happening now. So all of these factors, while they have an economic imperative, there is a political imperative that sits above it. It's about the will to do something that makes Australia economically strong. It's about sustaining our economy as we go forward. It is about political will to take some hard decisions. We've got one of the best salesmen we've had for some time. I mean, this is the strength of Malcolm Turnbull as a salesman. I would like to think that that skill is going to be used to tell us, the Australian people, why certain hard decisions need to be taken, why everything potentially can still be put back on the table, because at the end of the day, politics is going to have to generate a narrative around where the Australian economy needs to go. We are at a critical time. We're at a very critical time. So, take the document with you tonight, read it before you go to bed. As I say, it's page turner, will not put you to sleep. You'll want another copy to pass on to somebody that you know, and we're more than happy to make that available to you. But my job now really is to simply introduce our first speaker, Julie Toth. And background of all of the speakers in here today, I'm not going to go through it again, but please welcome Julie. Thank you.
Good morning, everyone. Okay. All right. Apparently we've all got 10 minutes each this morning and then a bit of a discussion. So I'm not going to dwell too much on the headline economy numbers, although that is sort of one of my favourite areas. Stephen's already given you a bit of an outline, and of course we will hear quite a lot more detail about the broad economic trends over lunch. Suffice to say that the headline numbers are okay, but they're not great. That 2 3/4 number, that means we are below trend. We have been for much of the past decade, actually. 2015 did look a fair bit better for many industries, and I am going to focus today on, very much the production side of what's going on rather than some of the other variables. And just a bit of a run through of what AI Group's seeing across our membership in various industries, and some of the highlights and the positives that we can draw out of that. I think for 2015 we did see a little bit of a change in mood and a bit of a role reversal between the mining sectors and the non-mining sectors of the economy. On this graph, for example, growth has really been dominated by mining output growth and investment growth, and that's the yellow line at the top. But as you can see, the other industries have been quite lacklustre. Probably for me, the most exciting bit in this little picture is that little uptick in the blue line right at the end there, because that's the services sector, which is 75% of the economy, a little bit more for employment. And that did start to strengthen through the latter part of 2015. So definitely slow growth, low numbers across the board for a while, but a little bit of promising growth there. One of the questions that I wanted to talk through with you today, which complements the CEDA report, is really what are businesses themselves expecting in 2016 and why, and what are they planning on doing about it? What we've seen in our own work, AI Group does, we only talk to businesses about their expectations and their confidence once a year, but the NAB survey, if you're interested, comes out every month, and that has quite a detailed confidence index in it. What we saw in the annual piece that we do, which we released in January, is quite an improvement in expectations for 2016 compared to the last 3 years in particular. 2015 definitely challenging and a bit of a disappointment for many businesses compared to what they were expecting, but far better than 2013 and 14, where we did see the majority of industrials anyway saying that conditions were worse than they'd been planning on. For 2016, we're seeing around 40% of businesses overall telling us that they expect conditions to be better than 2015, and around 37% expect no change. So on balance, quite a bit better. Looking across the major industry segments, there's a bit, as I said, there's a bit of role reversal going on. So the industrials and particularly the services sectors are more likely to be looking up. And the miners and the building industry, particularly commercial and engineering construction, they know they're on the downslope from here in terms of investment and probably output growth. Mining, not surprisingly, is probably the least positive of the group. In terms of sales, profits and jobs, about half of them are expecting 2016 to be worse, so they are planning on further cuts from here. Now, nationally, mining output is worth close to around 10% of GDP, more for export earnings, of course, but it only employs 2% of the workforce. It is a very capital-intensive industry, and it's also geographically concentrated, so these trends are far more important for Queensland than some of the southern states. Engineering construction is the other area that stands out for pessimism in 2016, and that really relates to the mining cycle as well. So coming off those big projects and also some of the government-related infrastructure work that is or isn't going ahead in other states. We're also hearing from the housing part of the construction sector that although conditions are relatively good, certainly in the inner city areas and the urban areas, that's not true nationally, and they can already see a peak in their workload and in the pipeline of forward work going through 2016. For the rest of the industries, it's roughly sort of 2/3 positive to 1/3 negative for their own sales prospects for 2016. And on the employment front, we can see about 1/3 are planning to hire more people and 1/3 are stable. But we do have a group there also that are planning on further job cuts, and that's mainly in mining and some of the industrials and construction. So what's the biggest swing factor? Definitely the Aussie dollar. When we ask what's the reason for your outcomes and your outlook for 2016, the biggest story is the lower dollar. It is a two-edged sword for a lot of industries and a lot of businesses because imported inputs have been rising as a response to the high dollar that we saw over recent years. So the lower dollar, definitely a net benefit. We're seeing it in export volumes, but also import replacement, which is less visible but no less important, particularly for some of our big industrials like the food and groceries and beverages sectors. Other positives we're hearing about are low interest rates, although, as Stephen already mentioned, that's not enough on its own to get businesses investing. Even when credit is cheap, you still need a reason to go out and expand your business. We're also seeing very low and stable inflation rates. Commodity pricing is bringing that down further. And improving consumer confidence, which seems to be down to that sort of circular loop with the labour market. We've seen better employment growth, lower unemployment rates, and that's feeding back into confidence. Possibly also related to the political leadership cycle, but I'd agree that that's already waning when you look at the confidence indicators more recently. How are we going? All right. The next question I wanted to bring up is this whole issue of industry rebalancing. It gets brought up quite a lot, that the Australian economy needs to rebalance and we need to find a broader range of growth drivers. What does that actually look like in practice? What it really refers to is the range of industries that are pushing growth through our economy. Over the last few years, it's really been mining output, but also the finance and insurance sector. It often surprises people to know that finance and insurance is our second largest industry in terms of output, almost the same size as mining, and it's been growing strongly. That reflects the size of superannuation, but also the strength of our big banks. The other big ones are construction and health services, and the drivers there are demographic related, as well as income and cycles. When we look at what's driving employment growth, healthcare and construction are the big ones there. Healthcare in particular is a bit of a sleepy giant that gets overlooked, but it employs 1.5 million Australians, 13% of the workforce, so it is huge. The growth rates for that industry, of course, are not overly influenced by the dollar, but we are seeing a little bit of a flow through in terms of better incomes growth. The other one that's been driving employment growth is education, and particularly education services, tertiary services. That's been growing rapidly, and we've seen international student numbers rise, and we do think there's plenty of room to grow there. The lower dollar hasn't yet been all that visible for professional services and business services, which I think is further down on that list. I think what's happening there is, even though they've got the boost from the dollar, it's being outweighed a little bit by slower demand from Asian markets for their exports and slower investment activity in Australia. So less going on in the turnover and acquisitions, that kind of thing. Manufacturing, I'll just touch on briefly. It's true that manufacturing is smaller than it once was. It's down to around 7% of GDP and about the same for employment. So literally half the share of the economy that it was a decade ago. But it is rebounding in some areas. So we are seeing growth and restructuring within manufacturing. I think someone's already touched on advanced manufacturing. We're also seeing solid growth in food, beverages, groceries, all of those consumable items that Australia does quite well. They account for nearly a quarter of our manufactured output at the moment, and they're growing quite strongly. The other categories of growth relate to the building industry and the construction cycle. So that's building products, but also household furnishings and household items. That's counted, of course, by the segment. Excuse me. That's countered, of course, by the fall in output from segments like automotive and the metals that are in decline, and they're probably dominating the growth numbers that you can see there. Excuse me, frog in my throat. So, what are some of the risks and concerns that businesses tell us about? Well, over the last few years, the number one concern is always customer demand, and I think that reflects the slow growth environment that we're seeing. In order to achieve growth, it's quite difficult to find greenfields customers out there, so there's a fair bit of competition and poaching going on. Expanding your market often does mean poaching onto a competitor's market, which is normal. So that's still the number one concern. The other area in there's quite a strong cluster around industrial relations and labour costs. So labour costs, wages are still a top concern for 17% of businesses asked. And related to that are skill shortages and concerns about industrial relations flexibility. So that's about the ability to move people around and to change roles. And even though the dollar's lower, quite a number, around 12%, are still saying that volatility in the dollar and the level that it is now is still an issue and an impediment for their business. That can work both ways, of course, because if you're importing, the low dollar's not all that helpful. And 14% are quite concerned about international competition and particularly online competition. So when we get to the political story, over the last couple of years, AI groups tried to put together, a fairly small and contained list of policy priorities. I think we whittled it down to about 5 last year, but that's really blown out. When we asked people, what's your priorities for government going into this election year, the number's actually grown to, 11 key issues, which is probably too many to digest, but I think it reflects the level of debate that we've had, but very little action on most of these issues. So, we've seen reviews, we've seen debate, but not much action. So the list has grown and it's still outstanding. Thank you. And I think we're moving on now to our next speaker.
Thanks very much, Julie. A brilliant zip through AI Group's work, of course, across so many different sectors. Now we will move straight along and welcome John O'Sullivan, who's the Chairman of Australian Investment Banking at Credit Suisse. Thanks very much, John.
Thanks, Carl. From an investment banker's perspective, 2016 is expected to be a bit of a bad news, good news story. I'm going to zip through a bit of a market overview, some of which Julie's already presented. And that's, if you like, the gloomy part. Then I'm going to talk about M&A, equity capital markets and debt capital markets. And the picture that I want to leave you with is, this is the good part. There's actually strong activity and not always uniform, particularly in equity and debt capital markets, but good, solid opportunities, good, solid growth. So turning to a market snapshot, that's the ASX 100 against the US S&P over the last 5 years. Don't need to say too much about it. I'm sure you all know the story, except to say, in Australia at least, it's been a bit of a grind. The US, we are 1.5% down on where we were 5 years ago, while the US is 40% up. Now, why that is, I'll leave to real economists, but I suspect easy money and the Bernanke put has at least had something to do with American strength. Perhaps more relevantly, in Australia, is a look at sector performance. This is a breakdown of ASX sector performance over a couple of periods. Now, if you look at that third column, the year to date, you can see it's a sea of almost unrelieved red. Real estate is the sort of tiny sliver of good news. Hardly worth noticing. But look at the right-hand side, the performance to 12 months. There, the obvious messages Julie's already signalled. Energy, which is essentially oil and gas, is down 37.9%. Miserable. We all know why. Materials, which is essentially mining in our language, is down 32%. Financials, we're all aware of the stock market performance of the banks, is down 22%. But then you look at, there's a couple of shoots of green. Healthcare is up, industrials is up, and utilities is up. And that supports the thesis that the stock market, at least, buys the transition story, that Australia is transitioning from energy, oil and gas and mining to industrials and services. Julie's talked about the dollar, and I won't say anything more about it except this. It's obviously fallen consistently over the last 3-year snapshot. The particular relevance that I want to draw out here is that while that's not a be-all and end-all for foreign investors, because they have to measure future returns in lower Australian dollars as well, but the headline price of lower Australian dollars is pricking up interest in foreign investment. So that's certainly helpful for us. Let me turn now to debt capital markets, a quick snapshot, using the US high yield market as a proxy for global debt capital markets generally. This shows both volume of high yield new issue and the yield since this time 2 years ago. What you can see is that undeniably there's been very little issuance in the last few months. So markets are nervous, debt markets have slowed and yields have increased. You can see that yield figure spiking up. And we all know CDS spreads have widened as well. So that might tell you, debt capital markets are terribly gloomy. But it's not unrelieved gloom. The market does distinguish between different sectors. This slide compares the all sector high yield index with the energy and coal index and then looks at what the all sector index minus energy and coal would look like. And what it tells you is that nobody's buying energy and coal debt, or if they are, they're extracting very high prices for it. But when you take out the energy and coal sector, yields drop considerably. So markets distinguish between sectors, and markets are available, open and available to sectors. Commodity prices, we all know about. This is gold, coal, gold, oil and iron ore for the last 3 years, and the iron ore and oil graphs tell you a lot about why Australian mining, why we need to transition out of oil and gas and mining into other sectors of the economy. Let me now turn quickly to the M&A outlook. And the first thing I guess you've got to look at is the macro trends. You'll hear more about these from, you've heard about them from Julian, you'll hear about them from Michael Blythe, but overall low interest rates, depreciating dollar, low inflation, low wage growth, an economy which seems to be transitioning reasonably well, continued growth prospects for Australia. So if you're sitting in Tokyo in an ex-growth Japan, you'd be looking at Australia and saying, what's not to like? And we are certainly seeing that. There is significant foreign interest in Australian M&A activity. The Chinese interest gets all the attention and is high profile. We all know we were recently involved in the sale of Pacific Hydro to State Power, but everybody knows about the Chinese investment or Chinese interest in Kidman, in poles and wires and other things. But don't forget the Japanese. Nippon has just acquired a big chunk of MLC Life from NAB, and Japan Post swooped down and grabbed Toll. And don't forget the Canadians. The Canadians are showing enormous faith in the Australian economy. The Asiano transaction at the moment has got Canadians on both sides. But the Canadian pension funds, CPPIB, Ontario Teachers, CDPQ, are very interested in Australian electricity assets, in ports and infrastructure generally. And I haven't mentioned here, but we see sovereign wealth funds from Qatar, Kuwait, all over the world are very interested in Australian assets. Turning to sector themes, the infrastructure theme bears that out, and there's a continued supply of assets, more governments joining in the sale queue. West Australia's now joined in. Who knows, one day Queensland might. I certainly won't speculate about that here. But it's not just governments, there's private sector interest. Asiana is the great example. In financial institutions, there will be significant activity because banks are rebalancing portfolios to meet capital requirements. So NAB got out of the UK got out of Clydesdale and the MLC, and that's a trend we'll see more of. Oil and gas, the theme is rationalisation. Who knows whether the PE bid for Santos was real to start with or will come again. I'm not going to make a comment on that, but that and the Woodside bid for Oil Search, those sorts of transactions show, gloom always brings some activity. Renewables, greater clarity about government interest has helped interest in that sector, as the sale of Pacific Hydro shows. In media, the prospect of change of ownership laws will certainly bring significant transaction work this year. In agriculture, the interest in the Kidman properties, the recent Chinese and other interest in dairy. Who can forget the Warrnambool sale? Is significant. In mining, there's a real question about, the question there is, have we reached the bottom yet? Big miners, Anglo has just announced sales of coal assets. There will be other transactions there. Healthcare and education driven by government reforms, and real estate, there'll be continued transactions. In equity capital markets, you might think it's all doom and gloom, and those stock market charts would not show you too much optimism. But I can assure you there is significant interest among super funds and investors. There's significant liquidity and interest in providing funds for growth projects. We find no difficulty in funding well-structured, good quality M&A projects, for example, with equity or debt. There's significant continued interest in, there's a lot of liquidity sloshing around in super funds and other investors, and they want to put it to work in growth projects. So for good quality acquisitions, we almost get knocked over in the rush. Balance sheet repair will be another theme this year. We've already seen some of it last year with the banks and with Santos, and there'll be more this year. So again, plenty of supply for the right project. IPOs, well, I put a question mark there because I don't know the answer. If anybody does, please let me know. Finally, to close on debt capital markets, debt capital markets are nervous, both in Australia and overseas. Issuance is down, as we've seen, but we certainly see some sectors are easily able to access all the debt they need. It's obviously difficult for others. I'm not going to predict where they're going to go. Clearly there's a bit of nervousness in those markets at the moment. It has been affected to some extent by there's significant reduction in liquidity caused by government regulation in the last few years. Global investment banks, including mine, have significantly scaled back their fixed income departments, and that in turn significantly reduces liquidity levels in those markets. So that's not a positive. But overall, I guess the message I want to leave you with, particularly for the M&A market and for foreign investment in Australia, is a very positive one. Lots of opportunity. Thanks. I'll now ask Warren to come up.
Thanks, John, and I'd like to thank CEDA for the opportunity to speak at today's conference. What I'd like to do today is share with you the outcome of a recent review I conducted into Treasury's forecasting performance and capability. Today's remarks are very much an abridged version of that review. A full speech will be published by CEDA and the Treasury will publish the full review and its response in a couple of weeks' time. In putting together my remarks today, I'm taking several aspects of the review that I think are most relevant for this conference, and in particular how you should think about the evolution of the economy and how you should use economic forecasts in the very uncertain economic environment. And what I'd like to do today is focus on three issues. One is the unusual degree of error in economic forecasts over the past couple of years. The second is explore some of the reasons for this. And the third is to consider how we should use forecasts in this environment. Now, the past decade has been a very challenging one for economic forecasters. We have seen unprecedented shocks to the global economy and perhaps more so to Australia in that time. We've had the commodity price boom, the financial crisis of 2008, the big decline in mining investment and the decline in commodity prices. And we've also seen extraordinary macroeconomic policies implemented around the world. So in that environment, it's not surprising that economic forecasters have been challenged. Now, the key feature, the distinguishing feature of economic forecasting in the past 5 years has been the persistent over-prediction of economic growth. That's happened around the world. You can see that in the IMF forecast for the global economy. It's happened in Australia. You can see the consensus forecasts for the Australian economy. Treasury's forecasts show exactly the same pattern as well. That since the financial crisis, forecasters have persistently overestimated economic growth, and forecasts have been revised down over time. And this is happening as we speak because the IMF has recently revised down its forecasts. Now, this is a little unusual. Economic forecasts are mostly wrong, but history tends to show that they're not often persistently wrong in the same direction for any length of time. So this is an unusual event that we're working through. Now, I think there's specific economic reasons for that I'll canvass later, but I also think that forecasters in general just find it very difficult to incorporate unusual events or large shocks into their forecasts. Now, in my review of Treasury's forecasting capacity, I noticed that Treasury's forecasts did very well in normal times, but were challenged when conditions were unusual. Treasury's forecasts were punctuated by persistent and sometimes larger errors over horizons that were relevant for policymakers and their advisors. This can be seen in the following chart, which compares Treasury's forecasts for nominal GDP growth, which is on the horizontal axis, with forecasts with outcomes for nominal GDP growth on the vertical axis. And you can see three distinct periods in this chart. Forecasts regularly overestimated nominal GDP growth in the early 1990s and also since the financial crisis. On the other hand, forecasts for nominal GDP growth were regularly underestimated during the commodity price boom in the 2000s. Each of these episodes coincided with Treasury missing its inflation forecasts as measured by the GDP deflator. In the early 1990s, Treasury overpredicted inflation. And more recently, the forecast did not incorporate fully the rapid rise in commodity prices and their subsequent fall. So, in the event, heightened volatility in Australia's commodity prices has made it much harder to forecast nominal GDP growth. And this was an outcome of previous forecasting reviews that Treasury has conducted. What's been a little bit more unusual in the recent period is that Treasury has persistently erred in its forecasts for real GDP growth. So this is the same chart, but for real GDP rather than nominal GDP. And you can see in the 1990s and 2000s, there was no persistent bias in the forecast. The errors were spread around the 45-degree line. But in the period since the financial crisis, like other forecasters, Treasury has regularly overpredicted real GDP growth. Now, in my review, I identified several reasons for this. The first, simply, is that it's harder to forecast when you're going through an unusual event or a persistent change in the structure of the economy. The second is more inherent in Treasury's forecasting practice and identified a likely bias in Treasury's forecasts to produce trend-like consensus outcomes. For a small open economy like Australia, persistent and short-term deviations from trend are likely to be caused by big global events, by big movements in our commodity prices or financial shocks. Now, all of these things are largely assumed to be unchanged or close to consensus in Treasury's forecasts. Treasury's Australian forecasts are underpinned by consensus and international agency forecasts for global economic growth. Moreover, the channels of influence from the global economy into the Australian economy are largely limited to its impact on our major trading partner growth. Obviously, the impact of the rest of the world on Australia is much more complex and much more fluid than that, but it's also much more difficult to embed in economic models or in judgment overlaying the forecasts. Commodity prices are also assumed to be unchanged in the forecast period, and financial markets are also largely assumed to be unchanged. So with these assumptions in place, it's very difficult to generate forecasts that are very far away from consensus or trend, unless you get a big change in consensus about the world economy, unless you have a big commodity price shock, or unless you have a big financial market event. And I think the consequences of this can be seen in the following chart. And this chart just shows the mean absolute errors around Treasury's forecasts for nominal GDP growth, real GDP growth and the GDP deflator. They're the blue columns, they're the forecasts produced at budget time, and the other columns are just simple trend following naive forecasts. And basically they assume that the economy will grow at or close to its recent trend over the next couple of years. And you can see that the outcomes, the errors in the Treasury's forecasts are not very much different than naive trend following models. So that's consistent with the notion that the forecasts tend to be biased towards trend or consensus, and therefore find it difficult to capture unusual events in the economy. Now, the third reason why I think Treasury finds it difficult to capture unusual events in the economy is that the sources of input into its forecasts are narrower than many other public sector forecasts. Now, to the extent that there's a consensus around best forecasting practice, economic forecasting practice, it is that you should use as wide a range of inputs as possible. Nothing's going to be right, most things are going to be inaccurate, but if you use a wide range of quantitative tools, historical experience and judgment, you're likely to triangulate a better outcome around the forecasts and, importantly, I think, have a better discussion around the risks of the forecasts. Treasury's current approach relies on fewer sources than many other public sector forecasters. It relies predominantly on a number of single sector models of the economy. That's not a problem in itself. The individual models provide a sound base for forecasting. They are rigorous and fit history well, but by definition, they are a narrow description of the economy. So what are the implications of this for Treasury's forecasts? There's a couple. It means that Treasury's forecasting approach is likely to generate reliable forecasts at times when economic conditions are normal, but they will be challenged at other times. There's therefore a high probability that structural changes or persistent shocks to the economy will not be adequately captured in the forecasts. Now, this is true for most forecasters. It's not just a Treasury issue. It is more difficult to forecast at those times. Now, in addition to the structure of how the forecasts are put together, there are clearly economic reasons for the underprediction of growth over the past couple of years. In hindsight, it's possible to patch together an explanation for this that would include the lingering consequences of the financial crisis, the more conservative savings attitude of the household sector, and the more conservative investment behaviour of the corporate sector. We've also seen slowing productivity growth around the world, and for Australia, this has been complemented by the big decline in mining investment, the big decline in commodity prices, and more recently, slower population growth. Each of these factors would be very difficult to incorporate into forecasts by themselves, but it's likely that the combination of them all hitting at the same time has made it very difficult to produce accurate forecasts of the economy. What's also likely in my view, but difficult to prove, is that there's a natural bias in economic forecasting, in fact in most forecasting, to assume that the past will be a reliable guide to the future. That's not a bad assumption most of the time, but will bias forecasts in periods like the present, when we are dealing with not one but a range of unusual factors. So with that in mind, I'd like to just provide some short advice on using forecasts in the current environment. So where does it leave us as users of economic forecasts? My strong advice is to treat point estimate forecasts of growth, inflation, particularly financial market variables, the budget, as just one of a range of outcomes that we may see. Now, one of the advances in forecasting practice in Treasury and in other public sector institutions around the world in the past couple of years has been more of an emphasis on the risks around the forecasts and the uncertainty around the forecasting outcomes, rather than a complete discussion of the point estimate forecasts. Now, while it's natural for the media and analysts to focus on point estimate budget forecasts, it's really only one of a range of reasonable outcomes. And you can see this in the following chart, which is just the underlying cash balance, the forecast going out a couple of years, and forecast errors based on historical experience of errors in budget forecasting. And you can see that there's a wide range of outcomes that are consistent with the types of forecast errors that we have seen in the past. The central point estimate economic forecast for growth or for the budget, is essentially an estimate of how the economy may look under one scenario, which assumes close to consensus global growth, unchanged commodity prices, unchanged financial markets. If we're wrong in any of these assumptions, the forecast will be wrong. Or if our understanding of how the economy works, given these assumptions, is wrong, the forecasts will be wrong. So to conclude, economic forecasting is hard. This is particularly the case when we are confronted by the types of unprecedented circumstances that we've seen over the past decade. A cynical view would be that forecasts are accurate when they're not very useful, but inaccurate when they're most needed. As a statement of fact, that is probably true, but to a large extent misses the point. The process of forecasting is not just about generating point estimate outcomes, even though they attract most of the attention. It's also about exploring the uncertainties around the outlook, as policy, business and investment decisions are all about probable outcomes in an uncertain world. That's no bad thing. And I'd like to hand over now to Jerry Epstein.
Thanks, Warren. Good morning, everyone. Where's the clicker? Anyone got the clicker? Thank you. What I'd like to do very quickly this morning is to give you a quick export business perspective and insights into what's happening in our industry. First of all, just a quick snapshot of who we are in Australia. We've been here since 1972. We employ about 5,000 people here. We turn over about $2 billion in revenue. We'd be in the top 10 logistics businesses here in Australia. We have 4 divisions, and they cover the whole end-to-end supply chain. We're part of the Deutsche Post Group, which employs 500,000 people globally, 220 countries, and with revenues of 56 billion. So quickly, what are our customers saying to us? Each year we conduct an export barometer, and what we do is we survey 600 exporters, predominantly in the manufacturing industry and service-related industries. These were the results over the last 13 odd years, but as you can see in 2015 we saw that there was quite a strong confidence in exporters that would increase their orders over the next 12 months. It went up to 66%, and we're seeing quite a good trend over the last 5 years. Without a doubt, the exchange rates had an impact on that export confidence. Where's it going to? New Zealand's on the top of the ladder. 57% of exporters go to New Zealand, up 4%. North America, 53%, up 7%. And then we have Asia, China and Southeast Asia, 39, 36, all trending upwards. What we're experiencing in our business, and I'm referring specifically to our Express division, is we've been traditionally a B2B, business-to-business company. We've moved more towards business-to-consumer. We're seeing significant growth in the SME market here in Australia. It's been very much driven by technology and e-commerce, whereas the web is allowing SMEs to sell direct to global end consumers and thus cutting out the middleman, i.e. distributors. So we're seeing a move from what we're saying, a commodity-driven to an innovative, high-quality product momentum. Exports of high-quality, high-volume product, especially with those organisations that have a high level of IP in design and marketing. It's very much driven by e-commerce. In the top 20 companies that trade with DHL, we've seen about 4 or 5 over the last 5 years just emerge into the top 20, and they're all very much online retail going to all parts of the world. So how can we sustain this going forward? It's very much technology driven. Very key to this is obviously the completion of the NBN and the information highway. We need to also continue to focus on infrastructure with developments of airports and ports. With the regulatory aspects, we need to see the continued reduction of barriers to trade. The FTAs are also going to have a major impact on Australian export. We've seen several FTAs signed recently, and we're also waiting for the TPP to be signed. The other big driver, and you've heard it from some of the other speakers before, is the exchange rate. Our products and services are obviously 30% cheaper than what they were only 4 or 5 years ago. So in summary, we definitely see a positive momentum in our business. We're seeing obviously China and Asia as a major potential growth area. Huge growing middle class in China and Asia, and what they're demanding is very much high quality products that we can produce here in Australia. So with that, thank you. I think we'll call the speakers up to the stage.
Love a seamless transition. CEDA prides itself on always providing opportunities for our guests to ask questions of our panellists or our guest speakers, and there's no difference, of course, with our economic and political overview today. However, since I have the microphone, I'm going to exercise moderator's privilege and perhaps direct a question to each one of our colleagues first, and then throw it open to general discussion. Julie, I was particularly taken by the fact that the priorities that your membership base sees needs to be tackled is growing. It's not getting less. And I'm always struck by the fact that we have federal budget, taxation reform and work relations are always pretty close to the top in each of that. I wonder, in terms of workplace relations though, I know we've heard much from the government about what they intend to do. But given the fact that wages in Australia over the last 3 years have grown very much below trend rates, that unionisation in Australia, the latest figures I saw, was about 14% and went up to about 17% if you added the public sector. Where is this flexibility, this change in work relations from your members' perspective? Where does it want to come from? What does it want to achieve?
Yeah, that's a good question. As you say, the list grew this year, and I think that reflected the fact that we've seen a lot of reviews from government on these topics, from the Productivity Commission, from Treasury, from elsewhere, but no decisions being made. So in the industrial relations space, we're really seeing the only changes coming are flowing through from the Fair Work Commission decisions. So we're not getting that policy overview approach to change. The flexibilities that people are seeking really relate to being able to respond to those structural changes in the economy. So, for example, businesses that want to change from one sector to another or from one type of production to another. So, yes, we do hear about wage costs, and particularly in the international context, relative wages, but we also hear about, skills flexibility and functional flexibility.
Okay, thank you. John, again, I was taken particularly by the fact that you illustrated what I think we've been hearing and what we'd like to see more of, and that is around Australia's economy in transition. And on the basis of the information you provided to us, you highlighted a number of particular parts of the economy, particularly services and so on, which were going to grow, and naturally we're seeing some of the others that perhaps been mining dependent are starting to fall off. But I wonder if you might just expand a little bit more about what it is about the Australian economy that it's so attractive still to international investors, and how significant international investment traditionally has been for Australia. We have always been a net importer of capital to sustain most of what we want to do, but particularly then reflect back on your comment that money is available through superannuation funds here in Australia for good projects, because that certainly is not what is out there in the broad community. People rightly or wrongly believe that it's foreign investment only that's taking place in this country that will sustain us going forward.
I highlighted foreign investment in particular because I guess I wanted to give us a sense of optimism. If the rest of the world thinks highly of Australia, maybe we shouldn't be too down on ourselves. And it is clear that we have always been net importers of capital. Typically, in the last sort of 5 years or so, something like at least 50% of public M&A transactions have involved, or significant M&A transactions, don't have to be public, have involved some foreign participation. Foreigners like Australia, they look at those macro factors that I mentioned. For example, they look at Australia with a 2.75% growth rate, and here we are wringing our hands about it. But if there are lots of places in the world where a 2.75% growth rate would be cause for national holiday. They look at a reasonably a stable environment, low political risk. We worry about sovereign risk, but we don't really have much sovereign risk by comparison with a lot of the other places in the world where people seek to invest. So there's a lot of great factors for foreigners, and that's why they continue to like Australia, and we should, as Australians, be happy about that. The second part of your question is about why the emphasis just on foreigners aren't Australian super funds and Australian pension funds also important. Answer: yes, they are, very much so. They tend, though, obviously they're by and large passive investors. Superannuation funds and the Future Fund and our other sovereign wealth funds, QIC, etc.
don't typically like control transactions. They recognise that they're essentially investors, not managers, and that's why you don't see them so often in certainly in contested M&A or M&A generally. You're increasingly seeing them in M&A transactions. For example, big pension funds are very interested in joining consortia for assets like, Transgrid in New South Wales, the ports, etc. So you're increasingly seeing the Australian super funds and pension funds investing in major projects, but it's usually they invest alongside an operator or a manager. Where the super funds and Australian investors do very well in supplying needed capital is in those recapitalisations, and those balance sheet repair jobs that need to be done. If you look at, when the banks recapitalised last year, big chunks of that is essentially superannuation money. So cause for optimism on sort of both sides of the ledger, both the foreign investors and the big Australian investors as well.
And the message about foreign investment, I thought, was important too in your comments, that it's not just the Chinese that are buying Australia.
Absolutely not. It's the Chinese get most of the publicity, or get a lot of publicity, and perhaps cause more nervousness among politicians and some commentators. But the Chinese are there've been waves of foreign investors. We had the Japanese in the 70s. And the Japanese are still investing. The Koreans are big investors. As I mentioned, sovereign wealth funds from all over the world are, clamouring to buy toll roads and ports and consortia. So it's not just the Chinese, although they're a big player.
Thanks. Warren, mate, where to start with you on Treasury forecasts? Put yourself in the position of, say, the current Treasurer or a former Treasurer, any government trying to make best guess estimates on how to drive the Australian economy, and on the basis of your commentary about the reliability of some of that forecasting, how if there's a major event, we simply don't know how to factor that in. Do you have some sympathy, since you came out of the private sector and only been in the Treasury for a short time, for any of those in the political class expected to make those critical economic and social decisions about Australia's future when there's so much uncertainty around just how accurate those forecasts can be?
Oh, I think that's a good observation, and that applies to most people, whether they're politicians designing policy or companies making investment decisions or people in the financial markets allocating capital. All of those decisions have to be undertaken in an uncertain world about what's going to happen in the future. I think it's just the nature of forecasting that the future is, to a large extent, unknowable. And we've seen over the past 10 years just remarkable shocks to the economy, orders of magnitude. They've all been historical events, and we've been trying to incorporate them into the forecasting process, and it's been particularly difficult. As I said, one of the advances in forecasting over the past decade or so is a much greater focus by the people who generate the forecasts on being more open about the uncertainties around their forecasts, being more open about the risks around their forecasts, and also going back and reviewing where their forecasts were wrong. And the message of that analysis really comes out in the last chart that I produced, which had a distribution around possible outcomes for forecasts. You see that the Treasury, central banks around the world are emphasising much more that, given what we know about the economy, the outcome could be occurring in a very diverse range. It does make it difficult for politicians in that environment, because the press naturally gravitates towards the point estimate of the forecasts and not the uncertainties around that.
Does the advent of the Parliamentary Budget Office, for example, eliminate then the constants that is the political environment in Australia of conflict? The fact that if we could get understanding from all sides of politics around some of the difficulties that you've pointed out here, do you think that, I mean, I know it won't, but I'm just asking your opinion. Do you think that will take the tension out of the political environment? Are we likely to see a bit more of an acceptance from all sides of politics that if the parameters that have been inserted into budget forecasting somehow don't work out, that this is an opportunity for political point scoring? There's got to be some other reason to sit behind it.
Well, that would be a good outcome if that happened. I think the more forecasters are honest about the uncertainties around their forecasts, I think it's a step in that direction. It's then up to the users of the forecasts to decide whether they use the full spectrum of uncertainties when they're putting their policy decisions in place or their investment decisions in place, or continue to focus on the point estimates of those forecasts.
Thank you. Gary, if I come to you, I was particularly intrigued by the fact that the growth that you're seeing currently in that export barometer is being very much driven by the SME sector, and your emphasis around technology, e-commerce, the importance of technology more generally, and, for example, the completion of the NBN. CEDA, some time ago, when it looked at the future of work, this was in June of this year, made those very points about the way in which the Australian economy was transitioning and the skills and so on that was necessary. From your perspective and from those folks that utilise the services you provide, do businesses recognise that training, skilling, educational opportunities and so on are going to be quite different from the workforce that they employ that are in those sort of SME areas? Because you did talk about, I think, high skill, high wage based sort of groups that make up, for example, advanced manufacturing or some of those smaller and medium-sized enterprises that would export and look to export. And secondly, how can government assist in that process of opening up that SME market, the export market, much more successfully than perhaps some small businesses are prepared to embrace at the moment?
What was the first one again? No, sorry. When I look at what's happened over the last several years, especially with some of the significant growth we've seen in SMEs, one thing that strikes me is the smarts, and that comes with that IP in marketing and design. Several of those major growth customers started very small, and they're quite significant right now. And what we've seen is this capability of the power of e-commerce on online retail, and how Australians can embrace that from down here and go global. And we've got this, I think, incredible innovative group of young people that are going into some of these organisations, and they're incredibly creative. Some of the companies that I've seen, they start very small, and just over a matter of 2 to 3 years, they just exploded, and they just can't keep up with the growth. So I think we've got an amazing opportunity with SMEs. I'll give you an example. You've heard of Flowhive? This is this company that builds little beehives down in Byron Bay, and these inventors came up with this really interesting design where it doesn't impact on the bees; the honey just comes straight out. Anyway, they went and did some crowdfunding, and they were trying to raise $70,000. They raised several $1 million and they just can't keep up with the orders. They've got about 30 or 40,000 orders, and they're trying to. I think they've got their manufacturing plant in here in Brisbane, and they're exporting all those. A lot of it is going to the USA, and we're delivering those into all parts of the states. That's just one example. There's a couple of major online retailers. If you go and see their establishments, you know, they're all in front of all these screens. They're designing, they're marketing, they're taking products, quality products to the world, and they just can't keep up with with some of the orders that they're taking on. What can government do? Well, get out of the way, I suppose. But also, it's about the regulatory aspects. They need to make sure that they open up more markets. FTAs, and I don't think we've seen the impact of all these free trade agreements that we've signed up just recently yet. But they're going to be incredibly important. How we get into China, for example, on a B2C basis, still it's a little bit difficult with regulatory aspects into China. There's a restriction on the value of items that you can take into China. I think it's about 1,000 RMB, just making sure that we take those barriers to trade down, and make it easier for SMEs to export. And that's why I'm so keen to see this NBN rollout gather more momentum. They're saying it's going to be completed by 2020. Sooner the better, because that'll open up regional areas as well. There's one company down in Cooma called Bird's Nest, Cooma, and they've actually created an enormous amount of employment just in that area, and they're an online retailer, exporting to not exporting to the world, but also a lot of demand within Australia. The other exciting thing that just happened just recently, I think it was last week, the US have raised their low value threshold. They used to have it at 200. They've raised it to 800 US dollars. So anything under 800 US dollars will go into the States duty and tax free. And there's a lot of, as you know, there's a lot of debate as to what we're going to do with our low value threshold coming in, which is currently 1,000, and that's being reviewed right now. So yeah, when it comes to governments and regulatory aspects, just simplify it and bring the barriers down.
Thank you, Gary. Okay, now the opportunity for you to ask questions of any of our panellists. If you could just signify who you are and where you're from and who you barrack for, that sort of stuff would be terrific. I have one right here. Thank you.
Thank you, panel. My name is Bob O'Connor at QT Graduate School of Business. A lot of the things we've talked about today have been the economy in transition. So actually, I should say I'm going to pose this to each of you in your different areas of context. Warren, you talked about how difficult it is to forecast in not normal times. I guess the contention I might put is disruption's here to stay. Is this the new normal? And I think that's really the essence of the question I'm posing to you, in that this notion of transition is one of opportunities and threats. And disruption, and I think, Gary, you've sort of talked about it in your industry. I'd be really interested in your thoughts on what do you see as the big opportunities and threats, potentially even down to the sector level, because really that's going to drive the economy as we go forward. So your thoughts in that area?
Anyone, put your hand up, please.
Warren, did you want to talk about that at a macro level? I'm happy to talk about individual sectors, sure, but there's a lot of them. Absolutely. Yeah.
No, I guess you're right at a macro level. We are going through a big transition, and the economy's had a lot of shocks, and your observation about disruption being here to stay is certainly the correct one. That can be reflected in the macro level in lots of different ways. Hopefully it's reflected by an acceleration in productivity growth as new businesses develop and more efficient ways of doing existing businesses improves as well. That will have implications for growth and inflation. Those types of things are very difficult to embed in macro analysis because they occur in a diffuse way through the economy. People who are close to the sectors where they're occurring or the businesses they're occurring will be much better placed to get a sense of that. Having said that, one of the things the Treasury does have an extensive business liaison program where we go out every quarter and talk to businesses, and I've been on one for the past couple of days, and the message we're hearing is very much the message that you're talking about, that people are changing the way they're doing business. They're trying to make themselves more efficient and run down costs. That's, I think, still yet to be reflected in the macro data, but it's something that we're thinking very closely about.
I guess in your context, globalisation is playing such a key macro role as well.
Oh, that's right. That's right. It's changing the nature of not only trade flows in the economy. Trade is one area where it's clearly having an impact. Seeing Chinese demand for everything go up. It's now benefiting our services sector, whereas it benefited the mining sector for a long period of time. But as John mentioned as well, it's also occurring in the capital account, seeing strong inflows into Australia, and the nature of those inflows are changing as well.
Julie, perhaps from a micro perspective?
Yeah, without going through every sector in detail, I think you're quite right. You know, this whole idea of transition and disruption is a constant. It always has been in economics, and it's just part of economics, really. That's the whole point of the discipline, is explaining all these changes and transitions, really. But this idea of, the whole new technology, new disruption theories, it's about identifying opportunities, as Gary said, and finding new niches. There's whole areas of product categories and service categories that didn't exist a decade ago, 2 decades ago, and they're turning into large areas of employment. So IT, telecoms, those online areas. One example of how it's showing up is the whole focus on business investment, and particularly, capital expenditure data. Everyone's been waiting for non-mining business investment to pick up, but some of those things are playing out at a structural level in that businesses are investing in online capabilities, they're investing in their telecoms rather than in bricks and mortar. So, it's just a different way of investing and a different way of using the skills that are within companies and that need to be brought in from elsewhere.
Further question? I have one there, and I have one down the very front here. Kerry, thank you.
Kerry Heron, Life Trustee for CEDA. Question, John O'Sullivan mentioned the waves of investment, and question coming in, just a little short story. Last year, Alan Jones ranted about the property in Northern Territory that was bought out by the Indonesians, and this selling of property to people overseas. What he didn't mention was that the vendor was the Sultan of Brunei. And Lord Vestey 100 years ago owned a huge swathe of Australia, and I think over the years there's been the Brazilians, the Yanks, heaps of overseas investment in agriculture, but over the years it's also averaged about 11%. It just keeps churning. I wonder though, the man in the street is worried about the amount of investment by overseas companies. Is there a sector or should there be any worry about the investment of overseas? And why is it that nobody talks about Australian companies that are investing outside Australia too?
To deal with the last point first about reciprocity, that's a very important point, reciprocity, particularly in a world of lots more free trade agreements. We can't expect other countries to welcome our investment if we close the doors to them. We've got lots of companies that want to invest in China, for example, and the doors won't exactly be wide open if we're unwelcoming of Chinese investment. Having said that, to the first part of your question, should there be restrictions? Should there be some areas of the economy that are subject to restrictions? Well, I guess that's a political question, but my personal view is I think we do currently regulate pretty well investment in those areas of the economy that do need special protection. Anything to do with national security needs special protection and needs special sensitivity, and I think we do that pretty well. FIRB and Treasury. Warren can tell me what Treasury think about foreign investment, but my experience is, the Australian agencies are very alive and understand those kinds of issues. They also understand the special questions raised by state-owned enterprises investing in Australia. State-owned enterprises don't necessarily have the kind of commercial drivers, predictable, rational commercial drivers that private sector entities do, but nonetheless, are terribly important investors. In the case of China, for example, where most investment from China is by state-owned enterprises, we have welcomed that in most areas, and so we should. So I guess the short summary is, I don't want to get into agriculture. Is obviously a difficult area, a politically sensitive area. I'll leave, my personal views out of it and leave it to the politicians. But that's an area for debate. I think the areas where we would all agree that some care is required are national security, and those national policy issues. But I think we do. I think Australia is a very open economy by and large, and we regulate those sectors pretty well. Don't know if Warren has a different view from Treasury. Maybe he can't say.
No, I just reflect your views, to be honest. I think they're a good reflection of the debate.
Please. Thank you.
Matt Grant from the Officer Coordinator General, and Stephen Ibarrick for Brisbane Lions, Brisbane Roar, Queensland State of Origin team, and I don't give a toss about Big Bash.
Cut him off.
My question arises, at least a couple of speakers talked about growth in the health sector, and also there was a comment about the longer term concern about growth in government deficit. So thinking about spiralling health costs, is there, in the positive, in the growth of health sector jobs and development, is that likely, or to what extent is that likely to reflect back on government debt, given that a considerable part of the cost of healthcare in Australia comes back to Medicare, etc. So, is there some sobering cautions that aspects that both the industry and government should be addressing a lot more than it is now?
The healthcare industry, as you say, it's growing, but it includes aged care and community services and childcare. Fairly big chunks of the growth pockets are private sector. So to the extent that those areas are being driven by income growth as well as by demographics, there's not too many implications for government budgets. But the areas of critical care, hospitals, etc., that obviously is mainly government funded the way it's set up at the moment. So it's definitely an area that needs to be addressed. I don't think it's realistic to just say costs will be cut, because we haven't been able to cut costs. And I think because of the demographic situation we face, it's probably not realistic to even try to address the expenditure situation by simply trying to cut it.
I'm no expert on healthcare, so I won't dive in there. I guess
reflect on two things. One is the demographics that Julie mentioned, that's inevitable. With an ageing population, older people tend to have a per capita higher spend on health over time. So obviously we've got to focus on ways to increase the efficiency of the healthcare sector. But I think there's also a choice element in this, and people are choosing to spend more on healthcare as well as new advances are made. And so we have to balance both of those things, the demand-driven decisions by the population in general and some of the demographic things that we're going to have to confront over the next few decades.
It's an area where you can see the effects of new technologies on almost a daily or weekly basis too. So when we talk about, economies in transition, it's definitely a sector where advanced technology and new technology comes to the fore.
And I would just remind you to have a look at CEDA's report of 2 years ago. Healthcare reform or ration, which will give you a few ideas on how governments could tackle some of the problems confronting the health industry. Of course, you do have premiers that have got different views on this, raising the Medicare levy and hypothecating the money directly for healthcare. You had others that suggested part of the GST debate might have involved that as well. You've got a minister at the federal level that's introduced some changes, particularly around some basic procedures and so on, where costs are going to go up. So healthcare is an issue that's alive and well in this country at the present moment, and will only get more vocal, because I think Julie's right, and I think certainly Warren is right. There are more choices being made by people now because advances in medical technology mean that we are living longer, we choose to want to live longer, and if we can prolong that in a healthy lifestyle, that we're going to involve ourselves in taking everything from healthcare products to whatever else it might be. So it's a long debate. I'm mindful of the time and know that we are going to move to the next room shortly. I have time for one final question, and it is right there.
Thank you. My name's Susan Pienaar from Queensland Rail. I'm just interested, Julie, in your comment around skill shortages. I note in the graphs that they're actually of more concern now than in the last 3 years. What would be your explanation as to what the sentiment is? Is it that there is an ageing population, or is it a skill shortage related to new skills for the the digital age, or is it that government haven't invested as much as they possibly have over the years in skills development and training? What's the major sentiment amongst your members?
Yeah, that's a good question, because education and training is vital, of course. The main areas of skill shortage that we see consistently are the STEM groups: science, technology, engineering and maths. So, that's true for the technology areas, transport and logistics, industrials. Most industries do need people with those skills. At the bottom level, we also hear about language and literacy and numeracy still creating barriers at the lower skill levels to being able to move people up and around within a company or into new roles. So there's two aspects going on. The third one, which is unique to manufacturing, manufacturing to some extent suffers a bit of an image problem in Australia, particularly for the sectors that are still large but are shrinking. So what we're seeing is this paradox of a shrinking total workforce in things like metals manufacturing and particularly automotive, and that shrinkage actually is a negative for attracting people into those industries, particularly younger workers who are more attracted to banking and finance and other areas that are a little bit more glamorous and less grubby.
And I'd refer you to CEDA's report of April of last year on advanced manufacturing. You'll get some insights into the nature of which Australia's manufacturing industry is very much changing, and we've got to change some of the language and the perceptions around just where opportunities for growth in the Australian economy actually lie. And I'd also refer you to the Minister for Education in New South Wales' comments yesterday suggesting that universities should stop accepting people into training programs for nurses and school teaching because we have too many of them. Interesting point of view. I'm sorry, but that's where we're going to end. To thank our panellists, can I invite Cole Murphy back to the podium? Thank you.
Okay, thank you very much, Stephen, and thank you all for your questions and your comments. But what I'd like to do before we move off for lunch is ask you to join us in thanking very much these panellists who've all of them travelled to Brisbane, spent time preparing, spoken freely in their expertise area and added to our understanding of the economic and political environment for 2016. So our thanks to Julie Toth, John O'Sullivan, Warren Teese and Gary Edstein. All of our speakers are a little bit brilliant. They're all joining us for lunch, as are all of you. So you may have the opportunity to grab them or follow up questions, and that means they'll have an opportunity to meet up with their gifts, which are actually in the other room at lunch. Look, many of the issues raised this morning, not just by speakers but by you in your questions, are topics that we will pursue in our forward program for CEDA through this year. And they're also the topics that we'll hear more about over lunch, with presentations by EPO report contributing editor, author Michael Blythe and Mark Textor. So we'll move outside now. You've got a short break and then we'll be taking our seats for lunch just after 12 o'clock. Your table for lunch for where you will sit is already on this name tag that you've got now. So do take your EPO report with you and also your program. That's the program with the full agenda and all the speakers' biographies, a list of of all the attendees and CEDA's upcoming events list. So I do hope that you enjoy our keynote lunch. We'll see you in there. Cheers. If I can ask you to take your seats now, we will be getting started. So good afternoon and welcome. I'm Carl Murphy, the State Director for CEDA here in Queensland. CEDA acknowledges that we meet today on Aboriginal land and pays respect to elders past and present. CEDA, the Committee for Economic Development of Australia, is a national independent organisation undertaking rigorous research, convening leading thinkers, and committed to progressing good public policy for Australia's economic development. Each year, for more than 30 years, CEDA has presented its Economic and Political Overview Report. This year, we're very pleased to have the EPO released in Queensland first, and to be live streaming presentations and discussions for the edification of those who could not be here in real life. Today's event is the first of 9 EPO forums CEDA will present around the country. Yep, 9. It's epic. And for their support in that, I want to thank CEDA national members and national economic and political overview sponsors, the University of Queensland, Australian Institute for Business and Economics. It's great to have the Institute's Director, Professor Paul Gollan, here, and you'll hear from Paul just shortly. Our thanks also to today's event supporting sponsor with whom we have worked for many, many years, CEDA members Colin, Biggers and Paisley. Now, each of you now have your 2016 EPO report, and as the first to receive it, I know you may not have yet finished reading it. But this year's report is a cracker, with, in addition to the economic and political overview chapters, contributions on Australia's business competitiveness, internal and external economic influences, and reforms for growth. It's pure CEDA. A report to inform your year ahead, providing insights and explanations and raising critical issues for discussion. This morning we started those discussions with presentations from Julie Toth of AI Group, John Sullivan from Credit Suisse, Warren Tees from Federal Treasury and Gary Adstein, who heads up DHL Express Oceania. So our thanks again to this morning's speakers, and our thanks in advance to our next speakers, EPO report contributing author Michael Blythe and Mark Textor. Our moderator today, off to a strong start from this morning's sessions and back up here after lunch, is CEDA Chief Executive Professor the Honourable Stephen Martin. In that program on your table, you'll see detailed biographies of all of today's speakers, and also in there a list of attendees, more information on the University of Queensland's Australian Institute for Business and Economics and on Colin, Biggers and Paisley. And for your forward planning, a listing in there of CEDA's upcoming events in Queensland. Also, I think on the front page or up on the screen, you'll see our Twitter hashtag for today's discussion, hashtag EPO 2016. So before we start, and before you all start your mad tweeting fest, let me acknowledge here today CEDA Director, State Advisory Council, State President Catherine Sinclair, and State Advisory Council members Professor Paul Gollan and Jacqueline Kelly. CEDA Governor John Massey, CEDA Honorary Life Trustees Kerry Heron and Rod Besley. Councillor Wayne Kratzman, an EPO contributing author, Head of Macro Research at Magellan Asset Management, Sam Churchill. It's great to have you all here today. I welcome also new CEDA members, UniSuper, and thank those CEDA members who are hosting colleagues, clients and guests at corporate tables, getting the year off to a cracking start. Australian Rail Track Corporation, Brisbane Convention and Exhibition Centre, Colin, Biggers and Paisley, Commonwealth Bank of Australia, the Department of Premier and Cabinet, EY, Ferrier Hodgson, Law in Order, Local Government Association of Queensland, Regional Development Australia, South East Queensland, the University of Queensland, and the University of Southern Queensland. Thank you. We welcome also media who are attending today, and thank you for your interest in CEDA's work locally and nationally. So I think that's everyone, and I'm very pleased to have you here. It's our first CEDA lunch for the year, and it seems to be going swimmingly so far. So to get us started on the 2016 EPO launch lunch and to introduce properly our keynote lunch speakers, please welcome the Director of the Australian Institute of Business and Economics at the University of Queensland, our Professor Paul Gollan.
Thank you very much. It's always a pleasure to be here at CEDA events, and thanks, Carl, for the introduction. I'd like to thank CEDA for this opportunity. We at the University of Queensland note the importance of the Economic and Political Overview series and its national and state focus on important issues to do with the economy and politics. A debate that is imperative for Australia in an increasing competitive globalised world. We at the Australian Institute of Business and Economics, as we say ABE, are proud to be the national sponsor for the EPO series. So let me tell you more about industry, government, university collaboration, which was a major part of the report that was released today, and also tell you a little bit more about the unique nature of our institute, ABE. First, I'd like you to begin for you to imagine the future. Imagine you had a crystal ball that could define your business challenges and opportunities and the best way to manage these. It is what every business and government wants, and it is, of course, impossible. What is possible, however, is to focus the brains of world-leading experts on the challenges and opportunities for your organisation and what your organisation faces. Experts that can apply their knowledge and rigorous academic modelling to help ensure that you are on the front foot what your future may hold. These experts are, of course, our world-leading and award-winning UQ academic and research staff, not only in business and economics and law, but across the entire university, often rank the top or near the top in Australia. I may not have a crystal ball, but I can see through a few thought bubbles occurring as you're listening to this. Oh no, universities, they're impossible to deal with. I don't understand the commercial imperatives. They don't respect my deadlines. There's the bureaucracy and don't talk about IP. All those issues. We understand that that's a perception and it may be a reality some time ago, but the reality of some time ago is very different today. And that's why the University of Queensland established the Australian Institute of Business and Economics. The interesting thing here, while we have 8 of Australia's universities, often ranked in the top 100, it is no secret that Australia is lagging behind the rest of the world in commercialising university research. Our Prime Minister recently highlighted a recent OECD report suggested that Australia was ranked near bottom of the list of OECD nations when it comes to commercialising university research. This is costing us dearly on lost commercial opportunities and future growth, a fact highlighted by the various Productivity Commission research and the government's own innovation statement, and numerous other reports, including the EPO report that you have in front of you today. The University of Queensland is an acknowledged leader of commercialising research in Australia. I'm sure many of you have heard about Ian Fraser's cervical cancer vaccine, licensed to CSL over 20 years ago, as one of the finest examples of successful commercialisation of university research. Another example at the University of Queensland was MRI innovations, using image correction technology that has been incorporated in 2/3 of all clinical MRI systems installed worldwide since the late 1990s. And now with ABE. UQ is set to cement this reputation in economics and business, utilising our world-class academics. The academics are recognised for the best in the world, often the top or near the top, being awarded national competitive grants. And our 3 schools, which combine our faculty, business, economics and law, are often ranked in the top 40 or 30 in the world in their respective fields. We believe ABE is a unique organisation in Australia, let's say, a one-stop shop located in a global top 50 university, bridging the gap between your needs and the academic expertise. We have access to more than 280 world-known experts in business, economics and law. Now, let's get on. What have we been doing and how that links to the EPA report? Over the last 18 months, since its conception, we've been managing a series of commercial projects to ensure quality outcomes are delivered on time. One of the great benefits of working with us is the rigour and transparency. And let's be honest, unlike some organisations that undertake applied research, we are delighted to be able to share and publish our modelling if our business partners wish us to do so. We aim to develop strong and long-term relationships, strategic relationships with industry and government. Many of the issues we are working on are highlighted in the EPA report launched by CEDA today, and may provide some glimpses into that crystal ball that I was talking about. Here are a few examples. One area highlighted in the EPA report was the importance of efficient infrastructure. Last year, we broke a 5-year strategic partnership with UQ and the Port of Brisbane Authority, worth over $2 million, to help future-proof the Port of Brisbane as Queensland's economic engine, utilising our engineering expertise with our business and economic world-class knowledge. We are working with the authority to develop port-related engineering solutions and technology. And I also understand that the Queensland Government, with possible support from the Queensland Treasury through its new market-led proposal scheme, in developing a new cruise ship terminal, which also not only looking at supply chains but boost tourism. We also have one of the world's best tourism clusters in our faculty. So as you can see, there's a number of areas that we can touch upon. There's also another important issue raised in the EPA report, was the future of work. Recently, we completed a pilot project for the Australian Chamber of Commerce and Industry and the Federal Department of Industry, looking at the future drives and challenges of the future of work, including ageing workforce, and this has been mentioned earlier on today, workplace flexibility, a very important issue, as we saw in those graphs today, and diversity issues. This research highlighted the need for agility in the workplace and the drivers of creating agile organisations, commonly referred to as what we need to increase our productivity in the future. The aims of this research was to educate and inform small and medium-sized businesses and micro businesses, their businesses of 4 employees or less, in a fresh and innovative way by delivering not only academic rigour through research, but also generating channel-ready outputs for practitioners and small business. We're not just talking about academic reports here, that will be the basis. We will also need to diffuse that knowledge as widely as possible. Disruptive technology in innovation, another important issue raised in the EPA report. ABE is developing a relationship with Suncorp, exploring the impact of disruptive technology on the insurance industry. Very interesting project. For example, the impact of driverless cars that are less likely to crash, and the impact on the Australian insurance industry, which is a major profit earner for the industry, certainly in terms of personal insurance. ABE is also working with ANZ to produce a series of economic and financial reports about the short-term challenges facing Australia and Southeast Asia. And we also have a number of collaborative projects at the Queensland Treasury Corporation exploring social impact, environmental bonds, looking at the future investment potential, issues of great impact highlighted in the EPA report. We are also exploring the areas of environmental finance and in developing a university centre around the business and economics of health at UQ. It is a win-win situation because UQ welcomes the opportunity to extend its research to real-time commercial opportunities and challenges to produce relevant, high-quality research. And I'd like to congratulate the contributions made to the EPA report produced for this series. The issues raised by the report, including the ones in which I've just mentioned, like infrastructure, investment to improve productivity of Australian businesses and households, the importance of technology strategy improving Australia's productivity, challenges and opportunities on workforce participation, including female participation, the issue of China's economy shifting from consumption-orientated growth while its industrial sector is weaker, are important for Australia. All are critical issues for Australia's future. And lastly, the ending of the mining boom, so prominent here in Queensland, as highlighted in the EPA report, places significant challenges in finding opportunities and harnessing the knowledge, research and innovation that is currently underway at universities, industry and government. AIB was established to help provide that connection, to build upon what we already have achieved and will continue to achieve in the future. Now look, while AIB does not have a crystal ball, I like to think AIB is very much on the ball in addressing these important issues facing Australia's future and have been highlighted in that EPA report. Finally, I don't need a crystal ball to tell you a couple of things. I am sure today you're going to enjoy a stimulating and lively discussion with our two presenters and a discussion to follow. And not too distant, hopefully you'll hear a hell of a lot more about AIB. AIB is proud to be associated with CEDA as a national sponsor for the EPA series. And now it's my great pleasure to introduce some very distinguished people. Michael Blythe, our first presenter, who we're presenting before lunch, is the Chief Economist and Managing Director of Economics at the Commonwealth Bank of Australia. His role encompasses monitoring, analysing, forecasting trends in the Australian economy and financial markets, and is a regular media commentator. You'll see him on the TV all the time. And in fact, he's just come over from the ABC, I understand. Michael spent 13 years in various roles with the Reserve Bank of Australia, the International Monetary Fund. From 91-95, he was the RBA's senior economist, and he joined the Commonwealth Bank in 95. So very distinguished indeed. After lunch, Mark Textor. Mark is a pollster, campaign strategist, and has been acknowledged as the most astute judge of public sentiment in Australia today. Mark's unique grasp of public opinion means he's led him to produce strategic advice to public and private sector, and was one of the 10 most powerful people in Australia by the Australian Financial Review. That's probably the case not only in Australia but the UK, since Mark just told you about half his operation is in the UK. Mark is a co-founder and managing director of Cosby and joins us today to provide insights into the political environment for the year ahead. Of course, they're full bios. They've got very long bios you can see in the pamphlet and the documentation in front of you. So thank you very much indeed for this opportunity. And Michael, please come to the stage.
Well, thank you very much, and good afternoon, everybody. I suppose when we're thinking about the economy, a lot has changed, it seems, in a remarkably short space of time when I compare what we were thinking at the end of last year to what has happened in the early part of 2016. And what we're really seeing, I suppose, is that the same pessimism that has characterised views on the Australian economy in recent years is again on display. The same debate about the risks of recession have resurfaced again, and it's easy in many ways to understand why. Now, we are going down that sort of depressingly familiar path that we've seen before of global growth downgrades, rising financial market uncertainty and volatility, and of course just concerns about the economic outlook in general. Now, having dragged the mood down, I'd like to say right up front though, that I think when we get to the end of 2016 and look back, we'll see an economy that we'll probably be pretty happy with. So we think we'll continue to grow at a below-trend pace for sure this year, but it's a long way from that recession risk that features in the conversation. I think we'll be still looking at an unemployment rate that's too high, but we think jobs growth will be positive through that period. Now, these conclusions no doubt look a little bit optimistic when you benchmark them against the fear and loathing in financial markets right to now. But equally, I would say that it's when you benchmark that fear and loathing, that volatility against the economic fundamentals, then financial markets do appear to be far too pessimistic. Now, these couple of charts here give you a bit of a feel for what is going on. So the chart on the left-hand side, those different squiggles there show you how forecasts for global growth have evolved over the last few years. And as you can see, there's a pretty standard forecasting rule here. You start forecasting at around about 4% for global growth, round about trend, round about average. And then as reality disappoints, you just revise those forecasts lower. And for sure, when you look at the red line and the blue line at the end there, the forecast for 2016, 2017, we are going down that same path. The chart on the right, it shows you a couple of measures of financial market stress. Now, this covers a whole range of variables in global markets, equity markets, interest rate markets, currency markets, all sorts of things go into it. But the bottom line is the higher those lines are on the right-hand side there, the more stress is in the global financial system. And you can take that chart back 4 or 5 years, and the sort of readings that we're seeing right now are the highest in that 4 or 5 year period. So growth downgrades, financial market volatility, and obviously a lot of concerns about the outlook on the back of that. But there's a couple of points to note here, really. The forecast revisions that we've seen in the latest numbers don't reflect some sort of general malaise that's seeing everybody revise lower. It's a range of specifics. So not surprisingly, given what oil prices have done, forecasts for oil producers have been lowered. You do have some big economies like Brazil that are in recession for a range of reasons right now. So it's kind of country-specific factors that are driving the revisions. And what's, I suppose, particularly important from an Australian point of view is the forecast for China in that global mix haven't been changed. So it's not quite as bad news story as it perhaps might first appear on that front. Financial markets, as people like to say, they've correctly predicted 10 out of the last 3 recessions. So we can't necessarily read too much into that, but there is a risk, I will admit, that we see that volatility feed back into global growth concerns and then into sentiment and the real economy and so on. So we can't entirely ignore markets, but it does look overdone, as I said before, when you benchmark it against reality. So why are we seeing this volatility? Well, the fundamental factors, if the explanations that you will hear people advance, is the US Fed. They're lifting interest rates. People are worried about how far and fast that set of rate rises will go. We can point the finger at China as well. Markets worry about Chinese growth prospects. They worry about the ability of Chinese policymakers to control what's going on there these days. But again, you need to take a step back, I think, and put some of these concerns into perspective. So the chart on the right-hand side here, for example, shows you what's happening with US interest rates, and that little blip at the end there is what concerns market participants. But by any longer run stretch of the imagination or reality, US interest rates are still extremely low. And if we get another 2 or 3 rate rises this year, US interest rates will still be extremely low by the standards of history. In fact, what's interesting about this chart, I suppose, is the last time that the US raised interest rates, that we had one of these tightening cycles, was back in 2006. Back then the iPhone didn't exist, to put it in some sort of context. So a lot of market players today haven't actually experienced a rate rise cycle, and that might explain some of the huge swings that we are seeing on that front. If we move over to China, well, the chart on the right there just shows you a few financial indicators for the Chinese economy, and just to pick one there, the black line shows you what's happening with the Chinese exchange rate against the US dollar. It has moved lower over the last couple of years. Some of those moves have created a lot of excitement and volatility in financial markets. But to put that into some perspective, over that period you can see on the chart the Chinese currency is weakened by 8%. Over that same period, the Aussie dollar dropped by 22%, and nobody really blinked an eye about that. So it does look again like an overreaction to what is really a very small move in a financial market price. I think there is one lesson that we should take away from this, though. We have known for a long time now that, of course, what happens in China is critical in driving global growth. It's critical in driving commodity demand. But we haven't really paid much attention to Chinese financial markets. But it's now very clear that China's reached the point that what happens in financial markets there will impact on markets around the world. And my attempt to show this and to show my children that I'm kind of hip and with it and understand the technology. The chart here, the green line, it shows you a Google trend search for the words China economy. And you can see the various spikes that occur in that Google trend from time to time. The other line on the chart is something called the VIX index. Now, it's actually a measure of volatility in US equity markets, but it's kind of universally known as the fear gauge. And whenever that index spikes up, it means there's a lot of volatility, uncertainty and concern in financial markets. And you can see the correlation that started to emerge there between those kind of spikes in concerns about China and their economy and that volatility and fear in financial markets. So certainly watching Chinese financial markets is now part of the job, I think. Of course, adding to the volatility and to the general fear has been the big collapse that we've seen in oil prices. And certainly looking back, those forecasts for a $200 a barrel oil that were pretty common a couple of years ago looked to have been a little bit off the mark. And no doubt a lot of people are revising their forecasts lower on the back of what we've seen. What I haven't seen in the debate, though, is discussion about the positives from lower oil prices. It is certainly bad news for those countries producing and exporting oil, but it's actually quite good news for everybody else. And just one example, the chart on the left-hand side here, the brown line, it shows you the oil price. I plotted upside down, so as the line's rising, that means oil's actually going down. But typically what happens when you get those big moves is that growth in the advanced economies, the green line on that chart, tends to move in the same direction. And again, if we drag it back to an Australian perspective, the fact is most of our major trading partners are oil importers. They should be getting quite a big income benefit from the drop in oil prices, and of course it's a sort of environment where we should benefit. Likewise, while there is this focus on rising interest rates in the US, elsewhere it's a different story. In Europe, in Japan, they're still cutting interest rates, negative interest rates in play there, and they're still pursuing their quantitative easing programs, so they're still buying government bonds. And what that chart on the right-hand side shows you, it looks at new issuance of government bonds in Europe, in the US and in Japan, less the amount of those bonds that are being bought by central banks in those areas. And those negative bars on the end tell you that these central banks are actually buying more government bonds than are being issued. Now, it's a simple matter of demand and supply here. That demand from central banks is driving up the price, which of course means that yields are actually falling. So in some ways, it doesn't really matter what the Fed may do with short-term interest rates. Those are longer-term interest rates that are more important for many economies in driving growth, and the like are going to remain very low. So, I mean, the point here is that a lot of these factors, I think, that are seen as growth negatives, more closely looked, there are some positives in the story there that should receive equal attention. The one area where we have a little bit more concern about the story is we think the threat is not so much from volatile stock markets, volatile interest rate markets. Perhaps the bigger risk and the area to watch most closely this time around is currency markets. And I say that because we're now into a period where global growth or global trade growth pretty much appears to have come to a halt. The chart here, the brown line there, it shows you global trade as a percentage of global GDP. And after 20 years or so of pretty rapid growth in that important driver, it's gone sideways in the intervening period. And I think what we're seeing there is not just weak growth in the global economy, but more an indication of that period where global value chains, global production chains were being set up has come to an end. They're all now largely complete. Setting up those chains did drive global growth. Countries that fixed their growth strategies into that part of the story did pretty well through that period, particularly in the Asian region. But if that source of growth is no longer there, then growth in many of these countries is going to be more about what's happening in the domestic economy. And that means, I guess, from a policy perspective, the question is how do you protect that domestic source of growth? How do you make sure it stays within your economy and doesn't spill out into other countries? And one of the ways you can pursue that objective is through a lower exchange rate. So I think it's no surprise that most countries these days actually want a lower exchange rate. Unfortunately, we can't all have that. So there's certainly a risk here. We think that currency wars is probably a little bit too much of an aggressive statement, but certainly there are plenty of risks there as we battle out on this currency front. And when it comes to these sort of generalised depreciations, one of the countries where you may see some upside pressure on the currency is in fact Australia. And of course, the last thing we want as well at the moment is a stronger Aussie dollar, now that we've kind of got it where we need to for our own economic considerations. But certainly watching the currency, I think, will be a pretty important indicator of risk in the broader story. Now, from what I've said so far, I think it's pretty obvious that we can see more global risks to the Australian story this year than domestic risks, but there are some local issues that are still playing out and will be important in how the economy performs this year. And these issues largely relate to the end of the resources boom and the fallout as commodity prices adjust lower and as that big mining construction boom winds down as well. The commodity price story translates through to an income risk in the Australian economy, and it's not just an income risk for commodity producers. It does work its way right through the Australian economic structure. So the chart on the left-hand side here, it shows you the broadest measure of Australian incomes. So it includes everything: government revenues, company profits, household incomes. In the last few years, we've seen income growing at rates that we'd normally expect to see in a recession. And in fact, you've got to go all the way back to the early 1960s to find anything that's been weaker than what we're experiencing right now. So that income pressure is certainly something that many companies are struggling with. The governments are clearly struggling with as they try to balance budgets, and clearly something that pressures household finances as well. So probably the most important forecast any Australian economist has to do right now is the outlook for commodity prices. Now, there's a good reason we have a 3-page disclaimer on the end of this, but our commodity forecasts say there's a little bit more downside, but we think we are near the bottom of the cycle there. So that income drag shouldn't get any worse, and in fact things may improve a little. The other issue, the downturn in the mining construction story, well, we've never been particularly worried about that because we thought we were pretty nicely placed to export the problem in a sense. So the chart on the right-hand side, the green line there, it shows you mining investment as a share of Australian GDP, and you can see our forecast on the end. The purple line shows you the number of people that are involved in resource construction activity. Those two lines move pretty closely together, and if our forecasts are right, well, there's certainly a further drag coming through from mining capex and further job losses to come as well. But as I say, I think we can export our way out of the problem in a sense. Of course, all of those new mines we've been building, all those LNG plants that are still under construction are going to deliver something, and what they will deliver is a big increase in our resource exports. And the chart on the left-hand side here, it shows you the contribution to economic growth from resource exports. And over the next couple of years, that ramping up in LNG production in particular is going to add something like 1% to GDP growth each year over the next few years. So that's a very solid support to the economy and a solid offset to the drop-off in mining capex. On the labour market, we've also managed to export the problem there, and you can see some of the trends that have been important in the chart on the right-hand side. So what is happening is these projects come to an end. The really highly skilled construction workers who are here on 457 visas, the green line on the chart, well, they're moving on to wherever the next big project is around the world. So we've exported them. It turns out a lot of these construction workers actually came from New Zealand, and if you look at the purple line there, most of them have gone back to New Zealand, so we've exported the problem to them. And finally, because of the strange nature of these jobs, most of them are that fly-in, fly-out category. What's happening in a sense is that people are losing their jobs in the Pilbara, let's say, where they work, but they're actually becoming unemployed in Sydney and Melbourne and so on, where they live. And if you are going to lose your job, well, that's the best place to be right now because it is where a lot of the new jobs are being created. So we've actually worked our way through this transition story in quite good shape. Economic growth is still positive, employment growth is still positive as well, despite the very big negatives that you've seen on those earlier charts. Can we keep it going, of course, is the real question. We do need to succeed in this transition towards non-mining led growth. And there's a couple of sectors there that we've been particularly keen to see work in this transition story. And I've picked those out on this chart here. So the idea was, as mining turns down, we'll have a pickup in residential construction, and that's certainly been happening. There's a major residential construction boom underway. We also wanted to see non-mining parts of the economy increase their business investment spending, But if you look at the blue line on the chart, that hasn't really happened. We've just tracked sideways through that period. The real disappointment, though, has been the green line, government infrastructure spending. What that chart's actually telling you is that government infrastructure spending today is 30% lower than it was back in 2012 at the height of the mining construction boom. So far from adding to growth, it's actually been one of the weaker parts of the economic story and a significant drag on the economy as a result. So we really do need to see that part of the story kick in over the next couple of years. We do need to see an increase in infrastructure spending, and I think pretty much every economist in the land would agree that it's a no-brainer. It's a great thing for supporting short-term demand in the economy. It's also something that adds to long-term productivity growth, which is essential for the longer-run health of the economy as well. And to be honest, when governments can borrow pretty much as much money as they like at 2.5% for 10-year money right now, if there isn't a whole range of projects that we can think of that will pay better than a 2.5% rate of return, we're not really trying, I suspect. So that's where we're hoping to see some increasing activity come through. Now, I don't want to leave you with the idea that the global story is just an entire negative for Australia. There are some medium-term aspects to this story that we should all be very well aware of in our businesses as well. And one way of illustrating that is this very interesting chart that I came across produced by McKinsey's. And what it shows you is how the centre of global economic gravity has moved over the last 2,000 years, essentially. And that global centre of gravity basically shifted from east to west with the emergence of Europe and the Industrial Revolution and so on, and then of course kept heading in that direction as the US took off. It was really only when we got into the 1960s and Japan started to take off, and then of course more recently with China and the rest of Asia moving higher, that centre of gravity has now started shifting back east. The point I want to make about this chart is it took nearly 2,000 years to go from east to west, but it looks like we're going back to where we started from in only about 40 or 50 years. And in fact, you can work out that means the centre of gravity is moving by about 140 kilometres a year, so it's almost fast enough to actually see. But the point there is, what's driving that? Well, what's driving it is a big growth in incomes in the Asian part of the world. The number of middle-income consumers in that group is growing at a very rapid rate, and it is delivering some potential benefits to the Australian economy. Because as incomes rise, there's a few things we know happen. People spend more money on food, more of it, and better quality. They want access to education. Like everybody else, they like to go on holidays. They want to live in bigger houses or apartments, and those bigger apartments are going to need more steel to hold them up. So there's a whole range of factors here that offer plenty of opportunities to the non-mining part of the economy, but we are going to have to pursue them. One example, I suppose, that's become very topical in recent times, just to highlight what the potential is here, is tourism. The chart on the left-hand side here shows you where Australian tourists, or tourists to Australia rather, are coming from, and the standout, of course, is the increase from China. So over the last 12 months, well over 1 million people from China have been to Australia for a holiday. And there are plenty that haven't been to China yet, so a long-term growth potential there. What we've discovered, though, is that Chinese tourists actually spend more when they're here than any other tourist, which you can see on the chart on the right-hand side. So it's not just more people, it's more people who are spending more as well. So it does highlight, as I say, there are plenty of growth opportunities for the non-resources part of the economy. Asia will remain important for us, not just as a commodity market, but at a market more broadly. And just finally to finish off, certainly 2016 will be a year of challenges. Some of them old challenges running on, some of them new challenges that will emerge. But you'd have to say that after 24 years of continuous economic growth, we're pretty well placed to deal with those challenges. Now, I'll finish at that point and leave you to enjoy your lunch. Thank you very much.
Thanks very much, Michael. Yes, do now stop, talk with your colleagues and your guests, and we'll come back after lunch to hear from Mark Textor. Good afternoon. I'm sorry to interrupt your conversation, but we are going to have to get ourselves started again. Damn, don't you hate that? I know that you weren't actually chatting, you were reading your EPO report. I hope that when you were reading it, you turned to the back. It's one of the best sections as far as I'm concerned. Starts on page 68, and it's a list of all the CEDA members all around the country who contribute to CEDA's research fund. That means they're not just supporting our work, not just like by being members, but by making that extra contribution. And we release those 4 research reports a year, preceded, of course, by the EPO today. To have another opinion, and I'm sure it will be opinionated, that's what he's here for. We're going to hear now from Mark Textor. You've heard Mark introduced properly, and then we'll move straight into a panel discussion. But thank you, Mark, very much for being in Brisbane with us today.
Thank you. Great pleasure to be here today. I'm of Italian heritage, so I need to wave my hands and move about in order to express myself. So one of the things that is true of all elections is they're all rather different. And a very good friend and mentor of mine, Richard Worthland, who was Ronald Reagan's pollster for his entire 16 years of California governor and president of the United States, said to me that each election is a unique set of combination of vectors and circumstances coming together. Whilst each one of those vectors might be historically familiar or seen by others, the combination is unique, and it's that combination we'll speak about today. Now, immediately I started to worry because I saw the title of this conference, the EPO conference. And of course, I'm the chairman of Australia's largest bike safety charity, the Amy Gillett Foundation. And of course, the drug of choice amongst professional cyclists for many years was EPO. And I can only assume that means you want to supercharge the economy somewhat illegally, perhaps devalue our currency even further than it was before. But also, in the role of the Amy Gillett Foundation, I also come across some interesting factoids, and one of those factoids is someone mentioned the rise and rise of driverless cars. And this actually speaks to choices and vectors, because one of the big debates in the safety community about driverless cars is they all sound very safe. They have a computer that works out what you want to do and where you want to go, and who will detect through various sensors on the cars what's coming up next, hopefully with more accuracy than the economists that we've spoken from today. But they detect various things and then they avoid an accident. But it's not that simple. So some of the motor manufacturers are contemplating putting the choice back on the consumer. That is, they might avoid an accident, but does that driverless Merc or Google car, God help us, run into the cyclist, run into the pole and kill the owner, run into something else and kill the owner, but not the owner, run into the pedestrian, or what? It's not as simple as technology. We have to make choices about what we want to do. The circumstances are not enough. The data is not enough. At the end of the day, we have to make choices, and that's what I want to touch on later. And of course, one of the things that's true about polling is, the first thing that's true about polling is it's a low barrier to entry. I'm a former econometrician, so the first thing they tell you about is a low barrier to entry. And you don't want to be one of those markets because everyone thinks they're an expert and they can do it for low price. That's politics. So I'm honoured to present to 250 political experts today, so thank you for your opinion. But elections are about 3 things. When you look at the next election you want to observe, think of 3 things. Issues, and that has some depth to it. That is, how relevant are those issues? Differentiation, that is, who's best or worst in those issues and who can manage those issues for better or worse. But the last one, and this is what's becoming more and more important, is the context of management of those two things. And we may deal with each in turn, perhaps. So what are the issues most important to Australia today? Well, here I want to get back to consumer opinion. So we've seen a lot of metadata about voters and consumers here today, but what are they actually thinking? So here I'll take an historical, perhaps, view. So what have Australians seen? And here there's been two schools of thought. There's been a school of thought, perhaps the Alan Jones school we'll call it, that Australians are strugglers and battlers and they battle their way through things and they need somehow protection from governments economically and etc. The other school of thought, which is somewhat different, is that Australians are somewhat economically arrogant. Over the last 25 years, they've sailed their way through the world on the back of the mining boom, have no idea of their relative economic privilege and want to party on somehow on middle-class welfare, etc. The truth is, of course, different from those two, and it describes the Australian condition. Australians have been aware of the unique position they've been in. They have been aware that they have uniquely favourable circumstances in terms of the demand for our energy and resources, our relatively stable economic base, our relatively good regulatory system. So, for example, many in the banking sector said after the GFC that we were saved by the banking sector. Most people thought we were saved by our regulation of the banking sector. So that they do feel privileged, and Australians do feel that they've been on this economic pedestal. They feel privileged for that. They didn't feel arrogant about it, but they do feel they have been on this pedestal. And of course, what they see now is that pedestal having or developing significant cracks. And it's a bit wobbly now, because obviously they've seen a dramatic change in our term of trade. Most of the indicators that were discussed this morning, particularly by our friend from Credit Suisse, are in fact observed by Australians. They did see a decline in our terms of trade. They do see a reduction in demand for our core goods. They do see an economy in transition from the resource sector to services. That's why even 5 years ago you saw politicians talking about a mini-pillared economy. Remember that in the 2010 election? The reason for that is Australians were recognising this transition even 5 years ago. So they're seeing a transitioning economy. And really the core issue is, how do we maintain this pedestal? Or if I get to get off this pedestal onto a lower pedestal, how do we make that transition in a safe way that won't further disrupt our political economy? In the meantime, you've had tremendous political disruption. You voted for Kevin Rudd in 2007, you got Julie Gillard, then you voted for Julie Gillard in 2010, and you got Kevin Rudd, and then you voted for Tony Abbott in 2013, and you got someone new again. And in addition to that, I think the number is closer to 20 of the number of state and federal leaders that have changed since 2007. Since 2007 also, you've seen planes shot from the sky, domestic terrorism in Sydney, Kaflika across the Middle East. So we've seen, even in the last 18 months, since 2 years since the election of the Abbott government in 2013, very dramatic changes. So the political economy is one of, I want more political stability and less gratuitous political change, but I do want growth and positive change in terms of the management of this transition. And the ability of political parties to convince voters that they are the best at that will be core to the next election. In that, there's some interesting sub-themes. Obviously, if you're pursuing a growth agenda, the old thing you used to do is promise more on infrastructure. But infrastructure is somewhat becoming like the African president promising a concrete statue of himself in Kinshasa. That is, it's a nice effigy for their glorification, but people are pretty cynical and there's less political return on investment in those investments because essentially it's seen as a grudge product now. That is, who wouldn't build it? You have to catch up. It's an essential part of a political economy, but don't thank me for doing it. Don't ask me to thank you for doing it. It's what you should be doing, like building schools and hospitals. And with schools and hospitals, there's an acknowledgement because they're told on television every night by political commentators and representatives from the banks on the financial grab on the end of the night, quite rightly, that there's less money going around. So you'll find that like a family dealing with lower economic or more challenging economic circumstances, their expectations are more realistic about what can be achieved. So in health and education, they want innovation in the way money is used, and that applies to urban infrastructure as well. So that's the issue context, and we might ask a few questions about other issues, but that's basically health and education, crime, ice on the streets tends to be these days, are much like they've been for the last 20 years. Not a lot of change there. It's really the economy and the growth and the transitioning question that has seen the most change. Then you get the differentiation, the second part of the intersection. And on differentiation, we've seen a change there as well over the last 20 years across Western democracy. We work for more than 4 Commonwealth Prime Ministers at the moment, and there's a commonality there in terms of all their populations viewing the differentiation between political entities and their offering differently. And the biggest has been a growing inelasticity in who's best at something. So if you take a rational approach and you measure it on various high-tech metrics about who's best for, say, interest rates or the economy or even a transitioning economy or who's best to manage health and so forth, you only get really quite inelastic movements in that now. No one's going to suddenly say who's been thinking Labor's best for managing industrial relations going to suddenly think that a right-wing party is, right? And vice versa for economic management. So those things on measurements have become relatively inelastic. And if you could imagine a horizontal versus vertical scale where vertical is becoming more important to vote, down, less important to vote, over one side is one political party, on the other side on the horizontal axis is another political party, the movements tend to be up and down now, not side to side. So the Dick Morris sort of era of stealing your opponent's game is probably less effective than it used to be, except maybe for certain elements of the economic message. What's become more important, however, is beyond those rational messages, rational things about who's best to handle typical portfolio areas, is managerial and emotional attitudes to those issues. So whether your values are rightly aligned in terms of where you want to go on health or education, whether you're competent, whether your motive is substantially good or bad, whether you have vision, all these non-rational parts, but not that they're irrational, but the non-rational parts have become more important. Particularly perceptions of competency. And this is in a recent column where I explained that you can't use as a leader in business or government anymore the excuse of you've been victimised by the media, because competency and your ability to deal with stakeholders is a key metric for whether you get voted in or out. Because if you can't manage the media, how can you manage the country? So managerial and political competence is becoming more important, largely because on the transitioning economy we've heard lots about, and the unknowns of all the unknowns, you want to know that someone is able to manage difficult issues. So in the old days, if a fire erupted in the kitchen, as I joked at the AFR tax summit, you'd say, don't worry, we've got a plan for a fire, we've got a strong position on fire, we're better than the opposition on fire. The kids these days just say, Dad, put out the bloody fire. So the adaptivity quotient, measured in various ways, is becoming very, very important. If you want to read on this, Taleb's anti-fragile is probably the best indication of the best form of robustness is agility. So the old, I've got a plan, we've got a stable position, is probably not as pertinent to political management as it previously had been. Competency and horizon. So the other new concept that I'd like to introduce is horizon. So you have to manage things adaptively. You have to be able to show that you're competent enough to change to changing circumstances. This is Malcolm's main message. But to the extent to which you have a fixed plan, that's about creating horizons for people, because there is an unknown. And the difference in politics than economics is you get to create your own horizon. Okay. Now, this is where economics start to come in. I was very interested in some of the wages and wages expectations graphs we saw this morning. And one of the real-world effects about wages is about the growth stuff that we talked about earlier, is the relevance of the growth agenda and the transitioning agenda is jobs first, second, third and fourth. And there's two elements to jobs. The first is obviously the old thing about job security and job availability if you don't have a job. In a transitioning economy, should I change my job? Should I find a job of sufficient, not only pay, but quality? But also the quality of jobs into the future. And that is, Australians don't really want their sons and daughters to grow up to be baristas and hair and nail polish people. They want their sons and daughters to have meaningful jobs into the future, just as that they want their jobs to be meaningful. And therefore, these jobs have to have growth horizons, intellectual or lifestyle growth horizons. That is interesting, you get to do different things, or wage growth horizon. I would contend, as a former crap economist for the ABS, that one of the issues affecting consumer confidence is a flatlining expectations on jobs, on wages growth. So the social equivalent that is, and personal equivalent, is feeling like you're stuck in a dead-end job. So the salience of Malcolm's message about it's actually quite an exciting time, we can embrace these opportunities, is very salient because it offers people that horizon of hope that they're needing for expansion of their own lives and that of their sons and daughters. There's really no other issue right now. So when people talk job opportunities, it's more than just the number of jobs available and the unemployment rate. Perhaps the more interesting area, though, is the contextual environment. And this is what political commentators, despite, you see them on TV all the time. So, I'm a political insider and I watch on television every night, political insiders talking about political insider stuff. And I've never seen these people. Never heard of them, never been at the table with them. Generally think their advice and commentary is muppetry. But nevertheless, they're political insiders. So you watch these Muppets on TV, and their vast campaign experience in the marginal seat of, bum whatever somewhere, as the junior campaign manager for a third-party candidate that never won. One of the things that's happening is, of course, is a two-speed political economy. And it gets to a much deeper issue of empowerment. So let's deal with a two-speed political economy. So there is now a derivative market for politics. So you are an otherwise intellectually and talent-challenged political commentator. You go on ABC The Drum or Sky or write a column in The Age, the ever-diminishing paper. And what's your job? Your job is to get paid $800 a column or $60 an appearance or whatever the pathetic fee is, to say something political about the event of the day. And those events of the day are hopefully substantial. Gonski, NDIS, the nature of the changing economy, what's happening with wage growth and what's happening with growth prospects, and the possibility of a disastrous devaluation of the yuan, for example, would be terrible. So these are issues of substantive interest to people, despite having technical elements. But they are relevant to people, therefore they will absorb much more information than they normally would. But instead of news services and social media giving them that information, there's now a community of people who are in the derivative market of politics. So they get $800 on television for not talking about the substance of that issue, because they're neither economists nor social experts, but turning it immediately into politics. What Gonski means for Julia Gillard's survival, what an education policy means for the gender gap in the vote, you know, who's up who in the Liberal Party zoo and the Labor Party zoo, and therefore straight away in the fast lane there's a monetisation of the derivation of an issue into politics. And so fast lane, right? Most derivative markets are quite odd, fast moving. In the slow lane is a family who just wants to know what NDIS is. What's that? In the slow lane is a family saying, what is the plan for a transitioning economy? And that differential is going to be key not only to this next Australian election but every election thereafter and around the world, how parties manage to calm down the political class and actually give people information that would persuade them to vote for them and show that they're competent, all those other things that I told you about is going to be key. The other part of the contextual environment to finish on is two other parts. The first is franchise, the second is somewhat more complicated, so I'll get the first. So the franchise. So if you are this Australian, and we made observations about the massive changes in our economy, so if you're an Australian and say, well, I didn't really have much to say about the global deal on climate, whether I agree with it or not, I voted for Julia Gillard in 2010 and I got Kevin Rudd, and I voted for Kevin Rudd in 2002 and I got Julia Gillard. I got a carbon tax I didn't vote for. I'm getting treaties I may approve of, but I didn't have a franchise in. So essentially, politically and economically, there's an argument that says that people have been disempowered. So they're reaching back into that power in new ways. So, for example, one of the little and interesting things that's happening is that for many years now, under the skin of the political geniuses that we talked about, under the radar from them is the rise of the environment as a significant issue locally. So whilst the environment as a national issue has waned from the peak days of 2007 and 10, certainly an important issue of substance, relative to their concerns about local environment, it's not as significant. And the local environment is about preserving your investment. Voters act like investors. They want to maximise their return and minimise their risk, politically or economically. And so what maximises their return? They do have power over their local member. Their local member can change the circumstances in which they live because they can preserve the local park and street and the reef, okay? And you can feel the power over that because there's a more direct franchise. And so the ability of people to perceive that they can make a difference in this political economy is key. And that's when we get to the really interesting bit. What you saw in the UK election, for example, was something really fascinating. And that is, there is one of the benefits of so much political talk and an increase in political observations is that people are relatively, although they're not interested in the gossip, they're relatively well politically informed. And that means, just like inflationary expectations that you were taught in 1980s economics classes at ANU, there's political expectations, behavioural changes. So in the UK, for example, in the 20 odd seats that the Conservative Party needed to win, mainly out of the seats they didn't win from the Liberal Democrats that they then had to subsequently govern with for 5 years, those people weren't asked to consider who the local member was or the issues. They straight away started gaming out what was going to happen at the end of the day. So given the polls and given their situation in the political economy of Britain, they were saying, well, I probably live in one of those 23 seats. It appears as though I do. So I really can't make much of a difference to the Lib Dems' fortunes because they're not going to win. So my vote is really not about the local member or about the issue. My vote is really about the extent to which I can affect or not a stable produce a stable majority government by giving David Cameron a vote, or even if they were more Labor-leaning than Lib Dems, or avoiding a Labor coalition, largely intellectually and leverage-led through the power of their coalition agreement through the SNP in Scotland, the Scottish National Party. And what we found is that people were prepared to vote tactically. Now, this has happened in marginal seats before in Australia, and it's happening now, and it's also happening in electorates like Epsom in New Zealand. So this is a really unique election because what it represents is the first time the maturation of a lot of issues have come together. The maturation of tactical voting thinking, well, not the total maturation, but the increasing maturity of tactical voting theory and opinion, the development of their fears and concerns about a transitioning economy, and the changing way in which they assess the competency of political parties. Now, all our previous speakers talked about changing, changing circumstances, making predictions difficult. If you think that these things can be measured by a fortnightly news poll, you are mad. Thank you.
Well, colleagues, as was the case this morning, of course, the opportunity is now available to you to put any questions for clarification you would like to our two panellists. If you do have a question, if you could just simply raise your hand, a microphone will be delivered to you. Question as opposed to a statement or an argument with either colleague up here. I could do that with Mark, but we won't. Put your question to one of the two panellists, please. I think that's a dessert being delivered here. Look, I'll start the process while you're all getting yourselves excited and thinking about this. Michael, I come to you first of all. In your presentation, what struck me was, again, and certainly in the contribution you made to our report, some of the issues around the way in which the labour market and the trending down in the mining sector and so on was going. The thing that stood out to me, though, was your comment about 457 visas and the fact that most of those were New Zealanders and they've all gone home or they're all in Bondi. I just wondered, that in itself was a pretty startling revelation, given some of the political arguments and dialogue that went on for so long in this country about who was coming in and who were not getting appropriate wages and so on. Did that surprise you when you looked at those statistics?
Yes. I mean, one of the surprises really in the economic story over the last couple of years is we've been any number of very high-profile job losses coming through in the mining side, other parts of the economy as well. But when you look at the official data, jobs growth has been positive all the way through that period of what seems like quite large job losses. So as fast as people were losing their jobs, people elsewhere were gaining them. And so it was trying to rationalise what was going on there that revealed the sort of things that we talked about. And there's also been an element of luck, it has to be said, in the story, and that luck comes down to the fact that most of the growth in the economy has actually been in the services side of things, and service industries tend to be a lot more labour intensive than those capital intensive industries like manufacturing and mining, where the job losses have been coming from. So that sort of contributional distribution of growth helped. Plus, it's yet another positive from what is generally seen as a negative. Wages growth has been very weak. In fact, labour costs in Australia have gone nowhere over the last three years. And labour costs are an input into that decision about hiring people. It's not just about output growth. The cost side also matters. So I think
income weakness that's seen as a negative, in fact, is one of the reasons our labour market has held up remarkably well.
Thank you. Mark, always delighted by any presentation that you give, because you set some very interesting directions for people to think about the nature of politics, and I was particularly taken by your comments around the contextual environment and talking about the two-speed political economy with the so-called experts that, looked after somebody in an election and didn't win and came not even third. But the other thing that particularly caught my attention was your comments towards the end around tactical voting. I'm sure it hasn't escaped your notice in the last week or so there was some modelling that has emerged that suggests that there was an opportunity, should the Senate voting system be changed for Australia, that those that would be advantaged by this would be the current government, in that they would probably win control of both houses, which hasn't happened since one of the elections with John Howard as Prime Minister, that the Greens and the Labor Party were of a mind to support some of those changes that the government was seeking to do, but it was all about elimination of micro-parties, about preference wrangling, where somebody could get 0.22% of the primary vote and yet end up as a senator. Your view on whether or not that is likely to happen, and the success, and does that model actually translate into something that's realistic?
Oh, I think if you're being courageous in ever predicting the final outcome of an election 6 months hence, given the level of dissonance about voting patterns, typical dissonance, although that's reducing, you'd be extremely courageous in saying, I think any change will result in, both houses of parliament being owned by having majority in both houses of parliament. I just don't see that conclusion being valid at all. There definitely needs to be some reform and fixing of a system that's now clearly been gamed in the Senate, to the extent to which you've seen it in comments to both the papers and in some polls, that people are worried beyond their franchise as a voter, just observing Australian society, that they're worried about what is happening in the Senate as an issue of itself, as opposed to how they might vote in it. And when you see both major political parties talking about Senate reform, I think they're also reflecting that if they already have enough economic worries and they want a settling down, get off the roller coaster politically of this mad sort of journey we've been through since 2007, well then of course it's completely consistent with that they would want some stability brought to the Senate, not necessarily by majority, but certainly by a more understandable set of outcomes as how their vote, or a tick on a box or a number, relates to an outcome in the Senate. And at the moment that's unknowable, so they do want more direct franchise in that, and the system cleaned up.
Okay, thank you. I have a question over here. Thank you.
Yes, good afternoon. Brett Wright from Heavy Vehicle Industry Australia. A question for Mark Textor. Yesterday we saw Malcolm Turnbull launch Infrastructure Australia's report. One of the interesting recommendations in that was for the heavy vehicle industry, but also all road users, and that was abolishing fuel excise and registration. Heavy vehicle industry would be affected within 5 years and everyone else within 10, which basically means technology fitted to every vehicle on the road, so they can of course charge you for the appropriate use, the more equitable use of the infrastructure. What is the likelihood of any government being able to implement a reform, given the privacy implications of fitting technology to every vehicle, both commercial vehicles and personal vehicles, and the likelihood of their success, you might say, and how would they go about prosecuting that argument?
Without wanting to cop out on that question, I'm the worst policy person you could speak to in politics. So unlike commentators on TV, I don't pretend to be what I'm not. I'm not aware of that policy. and I'm broadly aware of the announcement, but I haven't looked into the details. You do bring up an interesting question of privacy, though, because several of our speakers talk about reciprocity. It's happening now with cars. So right now, when you transfer the ownership of your car and say you have a decent one with GPS and so on, and it records for the purposes of the mechanics what you've done in that car, whether you've sped it or not, whether you've overrid the engine, whether you've changed the oil, the data from that car is transferred to the next from you to the next person, or in fact the manufacturer. So it brings up a broader issue, I think, in that one of the emerging issues that's a pregnant issue, that is not yet obvious but gestating, is that there is not a question around data privacy for people, but around data value. So if my data is being used by someone to improve the engineering of cars, or to fix the road system, or to help with the transport network, is what I'm paying in giving you that data, either voluntarily or not, being returned in value. Will it actually build better roads? Will it actually improve the safety of this car? Or are you just using that data without my permission and without giving me a rebate for it for your own profiteering purposes?
Thank you. Jeff Garrett, I'm with the Queensland Government. Mark, in your threefold key issues, you didn't really touch on, but perhaps you could, on the whole rise of personality politics, the whole Donald Trump et al. Saga in the US, and the disaffection with traditional career politics, and how that's influencing things going forward.
Without sounding extremely cynical, after 30 years of doing this, it happens all the time. There's always been personalities rising in politics. Disraeli was pretty much of a personality. Ronald Reagan was a big personality. And I was saying the same things about him. He's nuts, he'll have his finger on the trigger, disaffected voters, blue-collar Democrats. All that happens is people who haven't been through these things before think that something is new, and it's not. Every 20 or 30 years you have a dissatisfaction cycle. Perhaps there's another way to explain it. Maybe there's some really shit candidates because the other candidates are shit too.
You can come from Wollongong, my friend. Do I have any other questions from the floor? There being none, I'm now going to call on Kyle Murphy to wrap up today's proceedings and to formally thank our two speakers.
Thank you, Stephen, and thank you very much to all of our EPO speakers, but if you will now join me particularly in thanking from the lunch session these two. Michael Blythe, who's the Chief Economist and Managing Director of Economics at the Commonwealth Bank of Australia, and that Mark Textor guy, Managing Director of Cosby Textor. Thank you very much, gentlemen. Thank you, Stephen, for coming to Brisbane, for releasing the 2016 EPO. And for moderating today. Thanks also again to our economic and political overview sponsors, the University of Queensland Australian Institute of Business and Economics, who we are working with all around the country, and today's event's supporting sponsor, Colin Biggers and Paisley. It's great to be working with you guys each year. Many of the issues raised today will be pursued by CEDA throughout 2016 in our public events program, our trustee boardroom briefings, and our national research agenda. In that event program on your table, you'll see our upcoming events, including next week's presentation of the Economic and Political Overview in Townsville. That's a breakfast on Friday, the 26th of February. Warwick Agnew from Queensland Treasury, who'll be speaking, has been sitting here all day today, so he's got it all sorted, and he's going to hit the stage in Townsville next week, along with CEDA's Chief Economist, Nathan Taylor, and Commonwealth Bank Senior Economist, Michael Workman. Look, after that, our program here in Queensland spreads out across critical sectors and policy issues, many of which have been raised today. So on Thursday, the 3rd of March, you'll see tourism, policy investment discussion. No, you won't if you haven't already got a ticket, because that's sold out. So, bleep, bleep. On Friday, the 11th of March, health services with a keynote address from Martin Bowles, the Secretary of Federal Department of Health. Wednesday, the 23rd of March, we open the 2016 Women in Leadership series, of which we're very proud. And the series this year will focus on innovators, entrepreneurs and influencers, cross-policy impacts. On Tuesday, the 4th of April, we follow up on CEDA's 2015 research report on global networks to discuss international connections. International connections, connectedness, opportunities and export are all things that have come up today. So we've got a great cross-sector expert panel for that discussion, which is on the Gold Coast. A bit more international, on Wednesday the 13th of April, we're very pleased to be hosting here in Brisbane Sir David Higgins, who is of course the Executive Chairman of High Speed 2 and is in Brisbane to discuss for CEDA transport and infrastructure's role in transforming cities. The first of CEDA's 2016 research reports for the year is deficit to balance, and we'll present that with the budget repair panel on Tuesday the 19th of April. I'm banging on the whole list because it's the beginning of the year, okay? I just want to give you the picture. So that's the picture. It's all in the program. It's on the CEDA website. It's up there on the screen. Don't anybody tell me you didn't know. Do also tell your colleagues now about the EPO events around the country. And of course, like I said, next week up in the north. I'll drop you a note with more details on all of that and with links to today's live stream footage. And yes, Jared, you will also have access to all of the presentations and slides from this morning's speakers and from our speakers over lunch. I'll drop you a note with all that information in it, so you might want to refer back to it, or of course, please do refer it on to your colleagues. Just to make sure we've got your contact details up to date for the new year, please do leave your business card with my colleagues as you go. Okay, thank you for your contribution today and for your support of the work of the Committee of Economic Development of Australia. Do contact us directly if you have any suggestions or any questions about our work. We'll see you soon.